These are your top stories. The Adani rout continues, erasing some $118 billion from the group's combined market cap. Shares of the flagship Adani Enterprises fell 35% at one point, its biggest intraday drop ever. Underwhelming earnings from Alphabet, Apple, and Amazon weigh on market sentiment. It's more evidence that an economic slowdown is throttling demand. And the ECB says to expect another half-point hike next month, while the BOE warns the UK has a long way to go in the fight against inflation. We'll bring you more from our interview with the Governor, Andrew Bailey. Now, first thing is first, let's check on the futures. The open, a couple of seconds away, European stocks, you can see, under a little bit of pressure now. This is what we saw also in Asia after the correction yesterday. This is on the back of disappointing news, as we were just saying in the headlines, not only Apple, but also Amazon and Alphabet. So I guess there was a bit of positive sentiment earlier on from the NASDAQ. This really evaporated once we had some of the forward guidance from some of these companies. A tech trio, as we call them, showed that an economic slowdown not only is hurting demand for electronics, e-commerce, cloud computing, and digital advertising, but that it could last longer than maybe we thought it would. So as equity markets are now settling in, they're just opening. We'll have a look at what they're doing. The FTSE for the moment unchanged, but it could go to the downside. And then we look at the groups to see where we're seeing the most pressure. No doubt, even here in Europe, it's technology stocks that will take a lot of the pressure. And then we look at commodities, just always a good benchmark ahead of that Russia diesel ban next week. So let's also look at the big cross-asset checks. Now, it's given we've had not only Bank of England, ECB, but also the Fed this week. Always great to have a look at some of the currencies that have been on the move. Sterling yesterday under pressure. I was at that press conference at the Bank of England. Currently, if you look at cable, 121.94. Now, the picture overall is one of central banks trying to slow down their hikes, but also a complicated picture on how you get inflation from 6% to 2%. The U.S. 10-year yield, 3.3831, and then crude oil, 81.83. Now let's get over to our Bloomberg MLive managing editor. He's Mark Cudmore. Good morning, Mark. And you're looking at the Adani rout.
Yes, good morning, Fran. It's really quite an incredible story, what we've seen. You gave some of the size of the scope in the headlines there, so I won't repeat too much. But essentially, the conglomerate's lost more than half its value, over $100 billion wiped out in just the space of a week. Just these kind of immediately sharp drawdowns. The reason I want to draw attention to this is this isn't yet a macro story, but I think it might become one soon. I was at a macro roundtable dinner last night. No one cared about the India story right now. People debated China, they debated interest rates, they debated Japan, everything else. But India wasn't really relevant despite the Adani story. And that's because people have been kind of wondering about the valuations for a long period of time. It's very much been insulated. However, you must remember that India is the world's 5th largest economy. It is one of the largest stock markets in the world. The Indian stock market, despite the recent losses, is much larger than, well, not much larger, but it is larger than the UK stock market. And therefore, if this starts spreading just more broadly within India, if investors start worrying about some of the regulatory, the oversight within India, and start pulling out of that the Indian story, this is going to be a big blow to sentiment. There's going to be a big wealth impact. We're already seeing this. And this is going to be relevant because EM was one of the real consensus trades the last few weeks, bullish EM story. And with India being one of the largest EM markets, that's where a lot of that exposure is. So far, not really a macro story, but if Adani continues to suffer losses into next week, expect Europe to suddenly start paying attention a little bit belatedly.
Yeah, Mark, thank you so much. As ever, Bloomberg MLive Managing Editor Mark Cudmore. Now, tech shares slid in late trade after Apple, Amazon, and Alphabet all reported downbeat, disappointing earnings. Now, the results show an economic slowdown. It's hitting demand not only for e-commerce, but also in digital advertising and cloud computing. So joining us now is Alex Webb from Bloomberg Quick Take. Of course, he oversees all of our tech coverage there. So, Alex, great to speak to you. It was disappointing earnings, but what was surprising is that actually all categories are hit.
Yes, it's certainly the case. You know, we've seen hardware, software, cloud, all taking a hit. These are things where there was a lot of spending front-loaded during the course of the pandemic, perhaps therefore not as much spending now. In the cloud, we're also starting to see a slight pullback by some from the cloud. It is still growing very quickly, not quite the pace it was, as some people will take more processes on-prem, as it's known, back onto their own devices. Perhaps the biggest surprise was that, you know, they saw some painful results. Facebook also saw some painful results. Facebook stock jumped 20%. These guys clearly did not. They're down 6%. There's a far stronger narrative at Facebook about cost control. We have not seen that from these other companies yet. There were some comments around the edges, but Google's still saying that it expects its costs, CapEx, to be flat this year versus last year. That seems to have made a difference.
So, Alex, overall, and I think this is a really important point, is it that technology needs to see a bit of a adjustment in terms of those technology shares, or is it actually that we're going to see a severe downturn and this is a barometer of that?
I mean, potentially, look, the thing was super interesting. If you pulling on that, look at Apple, and Apple said there were two things that really hit it: supply chain constraints and the macroeconomic environment. Well, the macroeconomic environment is a little bit of a euphemism for demand, right? And that's the question lots of people are asking. Well, how much of it is lack of supply? How much of it is lack of demand? I think there is, across a lot of these spaces, a lot more lack of demand than maybe these companies are willing to admit in quite as many words.
But if you do cost cuts, you do well.
It's about that pivot. Are these companies starting to pivot away from just being the growth stocks we've known over the course of the past decade and a little bit more towards value? Cost cuts are an evidence of that. They're not just growing untrammeled anymore, at least in the near term, mid-term perhaps. Cost cuts again becoming more important.
Alex, thanks so much. As always, Bloomberg Quick Takes, Alex Webb. Now, the ECB says markets should expect another half-point hike next month. The warning comes as the Bank of England governor says the UK has a long way to go in the fight against inflation. Well, joining us now is Claudia Panzeri, head of equity strategies and tactical asset allocation at UBS Global Wealth Management. Claudia, thank you for joining us. When you look at what we heard from central banks, are we near the end of the hiking cycle?
Good morning, and good morning, Francine. Thank you for having me this morning in Bloomberg. So I think we are close to the end of the hiking cycle, but we are not close to the start of a cutting cycle. And I think most investors are already thinking about moving from hike to cut very quickly. And I think this is something which has been already priced and where we have probably a different idea. Clearly, we have still some rate hikes. ECB announced yesterday, they said another 25 basis point, probably 25 basis point. Yeah. The pivot of the central bank is now fully repriced. Lower volatility on the rate side has pushed up equities, and this is priced for me now.
But, Claudia, do you think there's a misunderstanding in the markets that the pivot assumes that actually we're going to see that the next move, or certainly by the end of the year, we could see some cuts? That's not the case if inflation gets stuck at 4 to 5%. So you bring it down from 8% to 5%, but then it's the last 2 basis points that are really difficult to get down to their target.
This is where I think there is the big difference between the market move we had over the last few weeks and our expectation. I mean, the market expects the Fed and the ECB to be ready to cut if the economy is slowing down. But probably this time around, because inflation is not yet back to the 2.2%, 2.5% as a target for central bank, the ECB and the Fed may stay at very high level of rate for a long period of time. And in that case, we know how the market reacts between the last rate hike and the first rate cut. The market can be easily up. But then if you have a major slowdown and the central bank do not cut quickly enough, then you have a market sell-off. So we still think that it's too early to be beta exposed, to add too much risk. We had added some risk, but always in relative trades.
So, Claudia, I took a bet this morning. I won't tell you on what side of the bet, but do you think the Bank of England it has one more hike to go and then they're done, or are they done now?
I think they have probably one more rate hike to go. They will probably wait to see the impact of the economy. This is what probably our central bank will do, see how much there is a lag between the rate hike and the impact of the economy. So the work has been done. We had a lot of hike already. The impact on the economy is getting clear. I think we don't see yet the impact on employment in US, but consumer spending is slowing down. Housing market is under pressure. So now the BOE, the Fed, and the ECB need to probably to do the last rate hike and then wait and see.
What do you think the earnings season, especially from the technology stocks that have really disappointed, mean for the rest of the economy? Are you taking a bet on technology, or are you taking a bet on equities on the back of disappointing figures?
So I think the market didn't care too much about the earnings season so far, because I didn't find this earnings season very inspiring. Most of the tech companies have been pointing out the risk of margin. Most of these companies are cutting down cost, but most of these companies also see slowing sales growth. And so far, the reason why earnings has been holding up was because sales in nominal term have been performing extremely well in US, in the Eurozone. Now that inflation is coming down, selling pricing are falling, and the economy is slowing, I think this should be a sort of warming signal, saying we should select companies and sector where margins are stable and where sales growth can be resilient. And I think the tech doesn't fit with all these elements. Valuations are still expensive, margin under pressure, sales are falling. So we keep the position of pure IT, tech stocks, not all growth stocks, but particularly on the tech stocks, still a negative position and is a negative recommendation, despite the market has been performing so well.
So, Claudia, what are you buying? I don't know. We had some pretty incredible dividend share buybacks from, for example, a lot of the energy companies. Is that a sector that you're looking at?
We still look energy. We have been on energy for a long period of time. It's very cheap. Free cash flow is positive. You had this announcement of share buyback. Dividend had been rising. And I think it's still a sector where we can see upside, because we still expect also an upside on the energy price itself. We also like where we are putting money, emerging market. I know there is this India, which is putting some pressure on emerging market, but emerging market is not only India, it's China. China is reopening, growth is improving, consumer spending will be up. So clearly valuation on the price earning have normalized, but price to book and ROI should improve. So emerging market could be one of the other market to look. Fixed income, we also move more positive on emerging market bond. I think across with fixed income, there are segments which are very appealing. IG in US, emerging market bond. So I think for people which wanna, let's say, have a more balanced, diversified portfolio, a mix between equities, which could be also healthcare, a consumer staple, and plus some fixed income with emerging market bond and IG could be something to think about.
Claudia, thank you so much. Claudia Panseri from UBS Global Wealth Management. Coming up, we focus on Adani's more than $100 billion market wipeout and how it's shaking investor sentiment in India. That's next, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Welcome back to the Open, everyone. 14 minutes into the European trading day. We're still seeing pressure across the board with the stocks European 600 down 0.5%. It's one of technology that actually disappointed Amazon, Apple, and Alphabet as well. And so there's a bit of nervousness about valuation technology, meaning that if you're not cost-cutting in that space, you may be in trouble with shareholders. Now, Adani's more than $100 billion crisis shakes investors' faith in India. That's today's big take story, which says Hindenburg's attack on the conglomerate raises bigger questions about India's credibility for global investors. Well, joining us now is our senior editor in India, Menka Doshi. Menka, thank you for joining us. So what's the latest on Adani, and are we actually seeing a risk contagion spread to other areas?
Francine, good afternoon. You pointed out this has been a record wipeout of wealth. I do want to add to that many Adani Group company shares are still trading at very, very high multiples. Adani Enterprise, the flagship, which had to withdraw its share sale, is still trading at an over 100 times multiple. That said, these are the 4 key things we're looking out for today, and I'll run through them very quickly. The continuing pressure on Adani share prices here in India, and whether that could have any kind of systemic impact on the Indian markets, or the contagion effect, as you pointed out. The bonds seem to have found some respite, given that Adani went through with a scheduled coupon payment yesterday. The second bit, financial institutions across the world checking in on their direct and indirect exposure to Adani. The reactions have ranged from Credit Suisse and Citi shunning Adani bonds as collateral to other international institutions expressing confidence in the underlying assets of the group. Indian banks so far have been sanguine. Third quick point, but the most important one here, is what Adani will do to raise funds next. He had to withdraw that share sale plan. How is he going to go about restoring both confidence and repaying debt in his group? And the fourth, very quickly, the political fallout. As yet, we have no comment from the government.
Yes, I was going to say, basically, what's been the government reaction? Could we see a scenario where Modi or the government offer or force the banks to step in?
Well, we've seen the opposition leaders seeking a debate in Parliament on the Adani matter, and Parliament was adjourned for a second day in a row on this very particular issue. The government so far has been steadfastly silent on the matter, Francine. We had a minister speak to Bloomberg yesterday, another one make a public comment. Both of them seem to shrug off any kind of broader economic or systemic impact of the Adani crisis on the Indian economy or markets, etc., saying they're one amongst many companies in the country in that particular sector or in the broader economy. So as yet, no acknowledgement from the government on how important this is, no sign of support or non-support one way or the other. The government has remained silent on this matter.
Yeah, but Adani is also quite close to the Prime Minister, right? They've been close for decades. Does this hurt the Prime Minister at all?
Well, perceptionally, yes, Francine. That's a tricky question to answer because, they both come from the state of Gujarat, where Prime Minister Narendra Modi was chief minister for several terms, and they're known to be close, though, Gautam Adani has denied seeking any kind of political favors for a very long time. Most political commentators see this as impacting Prime Minister Modi's image to some extent, because Gautam Adani's fortunes and the fortunes of the Adani Group were closely tied in to the broader industrial vision that Prime Minister Modi was laying out for India. But how deep that impact will be, how long it will sustain, and whether it will get lost in the heat of election, campaigning over the course of this year, we don't know. This is a fast-moving story, and it's not clear when fortunes will move or shift quickly.
Menka, thank you so much. Our senior editor in India, Menka Doshi, with the very latest on Adani. Coming up, how far is the UK from its interest rate peak? We hear from our interview with the governor, Andrew Bailey. That's coming up next, and this is Bloomberg.
Are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Will a slowing economy finally hit the U.S. job market?
The real test for the bear case seems to be jobless claims.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Have we returned to pre-pandemic labor force?
You could see jobs go down to, say, sub 100,000 in the next couple of months.
That'll get their attention on Wall Street.
The January Jobs Report, today on Bloomberg Television and Radio.
Welcome back to the Open. 21 minutes into the European trading day. Still, we're seeing losses across the board, with the European stock 600 down some 0.5%. Disappointing earnings from Amazon, but also Alphabet, and of course Apple pouring cold water on the rally that we saw the day before that was fueled by investor optimism over rates getting close to a peak. Now, talking about rates, the Bank of England voted to raise interest rates by 50 basis points, taking the UK's benchmark rate to 4%. The governor, Andrew Bailey, talked to us yesterday, and we tried to understand from him whether they still had one interest rate hike coming.
We don't have a view on the neutral rate which actually shapes our decision-making at the moment. And the reason for that, you might say that's an interesting thing for me to say, but the reason is that there is such uncertainty at the moment, in the landscape that we face. We've got very big moving parts. We've had very big shocks, and particularly very big shocks on the supply side.
But if you look at the market reaction, so you hiked by 50 basis points, and the market is taking this as a dovish message. Are they right?
Well, the market, of course, was expecting us to hike by 50 basis points, so I don't think they will have been surprised by that. I think the market will also be focused on what we do next. And they will have seen some change in our language, and that's deliberate. I mean, that change is obviously deliberate. The way I would interpret it is to say, we are going to react to the information and the evidence that we see. We haven't pre-announced an intention because we have reached a point. As I've said before, I think we have started to turn a corner. That's encouraging. There's a long way to go, and there are a lot of risks.
How soon do you think we'll see a cut from the Bank of England?
We're not in position of speculating on that at the moment. That's off somewhere in the future.
What? Not this year?
We're not speculating on what it is. I say in the future because, rates do go up and down in the long run, but we have no date in our speculation.
Governor, we've heard a lot from the Bank of England about the many shocks that this economy is facing.
Yes.
What's the prescription to fix this longer term?
Well, I think there's a number of issues that come out of them, obviously. Some of those shocks are external and relate to, very sadly, obviously, the war in Ukraine, which is terrible. We are beginning now to see energy prices come down quite rapidly. Food commodity prices have sort of seemed to have reached at least a level, but it's not coming through yet in retail food prices. So obviously that's important. Europe has had a much better winter from the point of view of energy than I think people feared, so that's important. And then domestically, labour supply is the big issue, I think.
Does getting closer to the EU change that? Does it change the trajectory for the UK economy?
In the context of the EU?
In the context of Brexit?
Well, I think what we would identify is at least three big shocks that we can see. There's been COVID, there's been energy, and there has been Brexit. It's very hard to separate them out, but the judgment that we've sort of reached on a rather tentative, but I think the evidence is pointing that way, is that we identified that there would be a shock to UK productivity from the reduced openness of the economy. We thought that might emerge over a rather longer period. On our latest evidence, it's probably going to emerge over a rather shorter period and possibly by the end of the forecast's horizon, so look forward 2 to 3 years.
Well, that was a little bit of our interview with the Bank of England Governor Andrew Bailey. Now let's check in on some of the stocks that are on the move at the open. Let's start with Caixa Bank. Now we have 3 stocks that we chose for you today. One is more to do with industry, but Caixa Bank rising some 2% after it came out with the 4-quarter earnings and guidance, saying that it does have enough tools to moderate the impact of inflation. The chief executive also said that Spanish banking tax is counterintuitive. For the moment, Caixa Bank on the up, gaining some 2.6%. Now, the other story, of course, is what we're seeing in technology over in the U.S. after Apple, Amazon, and Alphabet's downgrade, or if not downgraded, certainly did not be disappointed in earnings. Infineon, revenue pretty much in line with estimates in the fiscal first quarter, but a bit of pressure on the back of those earnings in the U.S. And finally, Sanofi forecast a slowdown in profit growth this year as there's generic competition, and that's been rationing up from multiple sclerosis drug Aubagio. Coming up, we will speak to Sanofi's chief financial officer. Watch the interview live on Bloomberg Surveillance, and that's at 9:30 a.m. UK time. This is Bloomberg. is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. While the Adani rout continues, erasing some $118 billion from the group's combined market cap, while shares of the flagship Adani Enterprises fell 35% at one point, its biggest intraday drop ever. Underwhelming earnings from Apple, Alphabet, and Amazon weigh on market sentiment. It's more evidence that an economic slowdown is actually throttling demand. And the ECB says to expect another half-point hike next month, while the BOE warns the UK has a long way to go in the fight against inflation. We'll bring you more from our interview with the governor, Andrew Bailey. Now, first thing is first, let's check on the sectors that are on the move. Overall, we're seeing a lot of pressure across the board. We did have a rally that was started by the Fed thanks to interest rates that may be in the mind of traders have peaked. That rally stopped yesterday when we had some disappointing figures from technology stocks, for technology companies like Amazon, Apple, and Alphabet. So overall, European stocks are a little bit down, 0.5% lower. The FTSE, I think, still being propped up by some of the energy stocks. And these are the sectors that are moving the most. So I imagine when we get it up, I will see technology amongst the biggest losers. And actually, they're kind of halfway, so they are not the biggest loser. It's 0.8% lower, but it's real estate, financial, and auto parts that are down the most, to around 1.5%. So the Bank of England has signaled that it may be coming to the end of its hiking spree. The governor, Andrew Bailey, warned that the risks are not gone yet.
I'm not saying there will be no more rises. Let's be very clear on that, because frankly, it is too uncertain at the moment.
However, one central bank stood out more than the rest in its rhetoric. The ECB president, Christine Lagarde, all but promised a half-point hike in March, while others signaled shifting to a more dovish stance. Now, here to unpick whether the ECB will be the last dove standing is Silvia Ardagna, head of European Economics Research at Barclays. Silvia, thank you so much for joining us. So do you think that the ECB is the last dove standing, or do they just want to make sure that the markets don't price a pivot ahead of time?
Hi, Francine. Good morning, and thanks for having me here. Well, 50 basis points for the next move is certainly there. I think what the ECB introduced yesterday in the market participant mind is the optionality of reassessing the picture after March when the new forecast is there. And so the dovishness of the meeting was in the fact that for May or June, we might have 25, we might have 50, we might have 0 interest rate increases going forward. And our own view is more on the dovish side, because we have a much faster decline in inflation than it's in the current ECB forecast. We think that not just the headline, but also core inflation has peaked.
But Sylvia, overall, is there merit in pausing just to try and understand what central banks, and this could be the Fed, the ECB, or the Bank of England, have done in the last 12 months? So if you look at where rates are now compared to the last 12 months, we need to understand also the effect this has, and of course we know that monetary policy is lagging.
Yes, I agree with that. I think if you ask my personal judgment on whether there is merit for what is worth, there is. Monetary policy acts with a lag. This has been the fastest monetary policy cycle that we have in recent history. The ECB, let's not forget, the starting point was minus 50 basis points. So there has been already 300 basis points of tightening that is in the pipeline. Some tightening is also taking place via the shrinkage of the balance sheet, which has been quite fast via the reimbursement of the TLTROs. So I think pausing and understanding how this monetary tightening will impact the real economy as merit. And for what is worth, I think is also the President reiterated that while there is an expectation that wage growth will pick up, so far we have seen wage growth that is pretty modest in the euro area when you compare it to what has happened in the US or in the UK. And it's very much in line with what the ECB has.
Sylvia, what was your take on what the Fed said? And actually, when Jay Powell was talking about financial conditions and the fact that the market is looking at shorter term and he looked at 12 months, was that confusing? Are we thinking that he's actually, do the markets want him to sound more dovish than he actually is?
Well, the market certainly interpret all the shifts in these central banks as being dovish. I mean, financial conditions are certainly more important for economic activity in the US than they are in the euro area or in the UK, because these banks rely much more, these two jurisdictions rely much more on banks. And for the euro area, if you look at the financing conditions, that tightened quite a lot, as you can see from the lending survey. So perhaps, going back to your question on the US, financial conditions matter for the real economy, but the cumulatively, when you compare where we were a year ago and where we are now, they certainly are tighter, as the Fed chairman said.
Sylvia, on the Bank of England, so we also spoke to the Governor, Andrew Bailey, yesterday. Are you expecting one more hike and then being done, or could they be done now?
Look, we expect one more hike by 25 basis points and then being done. We have flagged the risks that they could have done or at least pause for now. The onus, the proof will be on the data. And again, what we monitor quite closely is wage growth. Wage dynamics here, they've been pretty solid. There is, a very tight labor market still. And that's why we have one more hike in the pipeline.
And what does that mean for sterling?
Well, we have practically our FX, colleagues had, some upside for sterling. I think more generally, we are at a stage where perhaps it's not just the interest rate differentials that will make the difference for currency, given that all central banks are moving more or less in the same direction.
Sylvia, I distinctly got the feeling, certainly speaking to Andrew Bailey, that they were trying, I mean, he sounded much more dovish, but at the same time, he was really trying to keep all options open and saying, we just don't know what will happen. We just don't know what kind of economy we'll be left with because of external shocks. Do you think that's China, that we haven't fully understood what China reopening means for inflation and commodity demands?
Certainly, China, I think, plays a big role, frankly, because after all, we are energy importers. And so if China rebounds much fast, and that also brings up energy prices, that will mitigate the current disinflationary impulse that we are seeing. It is also that, again, fast moves in gas prices have been, very unusual relative to the past. And that's why the inflation spike has been so high that it's so fast, so quick. It's also difficult to assess whether it will leave or not any scarring on inflation expectations. So again, I think that the uncertainty, the fact that we don't know, is truth.
Silvia, thank you. Silvia Ardagna, Head of European Economics Research at Barclays. Now, coming up, the sell-off continues. Adani Group stock prices slide further, continuing the drop since the scathing Heidelberg report. We discuss that next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to the Open, everyone. 40 minutes into the European trading day. The picture is still one of pressure, although we're seeing the FTSE bucking the trend, getting some 0.1%. European stocks still 0.5% lower. They're really dropping on the back of three companies, a trio of earnings that disappointed. That's Alphabet, Apple, and Amazon. Now, the Adani rout has wiped out about half of the group's market cap value since the Heidelberg report. Shares of Adani stock have continued to sell off in Mumbai trading. Joining us now is our Bloomberg opinion columnist, Shirley Wren. Shirley, I've been really wanting to speak to you about this because you've been writing some amazing stories on the fallout and actually the second and third round effects of this. So what's Adani's biggest pressure point right now?
I think his biggest pressure point is to keep his financing channels, all of them open. Adani Group has over the years attracted a lot of capital, including global banks, global bond traders, so on and so forth. So with this global market rout, they might just freak out. All these global investors, they just might freak out and stop lending to Adani. And Adani really needs all of them to continue lending money to him, because what he is doing is a very capital-intensive business. If Adani Green Energy was costing him $10 billion a year in capital expenditure in 2022, he will need that amount of money for 23, 24, so on and so forth as well. So Adani's story is a bit different from China Evergrande's in that sense.
But so give me a sense, Shirley, and this is something that you were one of the first one that caught up, right? If there's a big margin call, like if investors freak out, could there be a systemic risk in this?
I think there will be a lot of questions being asked about Indian banks' valuation. I mean, Indian banks are not cheap. Even State Bank of India is trading at 1.5 times book, and that's higher than any Chinese banks, you know. And so like the State Bank of India did come out saying that their exposure to Adani is limited. But one question that the global investors will be asking is that what are your exposures? Are you worth so much money that you think you've been asking for? And that is one systemic risk on the Indian stock market in general.
So, and you just mentioned there that, a slight comparison between Adani and Evergrande. Is it fair? And who had it worst, actually?
Well, Evergrande has at its prime, I think, about 100 billion of net debt on its book, and the other stuff off book, and that's 5 times as much as Adani's. And China is a bigger beast than India, right? But I think in a way, Adani's investor base is more skittish. I mean, we're talking about ESG investors buying into Adani Green Energy, and the Norwegian's biggest pension fund, KLP, just came out saying that they have sold all their shares, right? And also like investment grade credit funds, they are also watching this very closely because Adani has about 14 billion of dollar bonds outstanding, and most of them are issuers that have investment grade. If they become fallen angels, all these credit funds will be forced to sell, and that can be quite skittish as well.
Actually, what does this mean for investment in India? Could you see the whole country taking a hit because of the perception?
I think they are already taking a hit. I think the problem is that it's not India has corporate governance issues. I mean, all emerging markets do, China, for instance, right? But I think the problem with India is its valuation is very, very high. That's the problem. And people are asking, are you deserving the kind of valuation premium that you're enjoying right now? Especially with China reopening, and China is very cheap.
Yeah, Julie, thank you so much for all of your insight. Julie Wren, Bloomberg opinion columnist. Now let's get straight to the Bloomberg Business Flash with Alice Atkins. Hi, Alice.
Hi, Francine. Bridgewater has named Karen Carniel-Tambor as its 3rd co-chief investment officer. She's the first woman to hold the top investing job at the world's largest hedge fund. Bridgewater is bulking up its management less than 4 months after billionaire founder Ray Dalio stepped down as one of the co-CIOs.
I think the Fed could tilt dovish in the near term relative to what's priced in, but it's very, very short-lived because at the end of the day, when you look at the basics of what's ahead of them, the Fed is going to face tough trade-offs. Over any kind of medium time frame, you're going to either have the economy slowing a lot more than is currently expected by markets. There's basically no earnings slowdown that's expected whatsoever. Or the Fed is going to see that they have to go back to tightening because they're not getting the inflation that they want.
Deutsche Bank is preparing further job cuts to keep costs in check, with the focus likely to be on areas outside the trading unit. CEO Christian Sewing says meeting expense targets in an inflationary environment will require further savings. 4th quarter pre-tax profit and revenue missed estimates as fixed income results trailed Wall Street for the first time in 10 quarters. Bloomberg has learned that hedge funds are now being targeted in a U.S. investigation into the use of WhatsApp and other messaging platforms for conducting business. Sources say the SEC has asked firms for evidence to determine if apps are being used to hide deals from compliance departments. It has already been fined for more than $1 billion fined banks more than $1 billion for violations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alice Atkins, and this is Bloomberg. Francine.
Alice, thank you so much. Alice Atkins in London. Now, tech shares took a beating in late trading after Apple, Amazon, and Alphabet all reported disappointing earnings. The results actually show that the sluggish economy is hitting demand for services, including cloud computing and digital advertising. Well, joining us now is Bloomberg tech reporter Aggie Cantrell in Berlin. Hi, Aggie. So should we have seen Apple's revenue drop coming?
Yes, so when we look at Apple, it's worth taking Tim Cook's own words for the current situation at the company, which is that Apple is not immune to global economic headwinds, be that, for instance, the China lockdowns that have had a continued effect on the company's supply chain, and also if you look at consumer sentiment, it's really weakening, and so Apple's products that are priced much higher than some of their competitors are really struggling to get into consumers' hands. And so essentially, yes, we should have seen Apple's downturn coming. This is a company that has already flagged concerns with its factories in China, its access to a lot of its supply chain, and its ability to roll out new products. And also, as I said, with the consumer sentiment side, inflation is really hitting the company.
So, Aggie, how will Alphabet Amazon then try to insulate themselves from headwinds going forward?
So Alphabet and Amazon are two of the many, many tech companies that have recently announced huge job cuts. These are companies that overhired during the pandemic and point to the issues along with the consumer sentiment, just as Apple did, when it comes to making sure that they're more efficient going forward. And I think the name of the game, as Jassy, the CEO of Amazon, put it, is essentially we're focusing on profitability. All of his meetings are about how to make the company more efficient. And so that's what these companies are looking forward going into this new year, is that essentially during the pandemic, these companies had a huge boom. Everyone was at home. Everyone was, the digital ad business was booming. So was the consumer tech products. And now they're turning around and saying, we're going to be profitable going forward, and we're going to tell our investors that we have a strategy to be nimbler and more efficient for the new year.
Aggie, thank you so much. I have to say, looking sharp in a red suit. I'm going to start a hashtag, twitting with Aggie, and it's going to go viral. Our Bloomberg tech reporter, Aggie Cantrell. Now, coming up, top EU officials are in Kyiv for a summit with President Zelensky, so we'll find out what to expect from the meeting. That's next, and this is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
This is Bloomberg.
For years, Russian refineries have been the EU's biggest fuel supplier, but no longer. New penalties plus existing curbs on crude could cost the Kremlin $280 million a day. And on top of that, Russia is significantly cutting gas exports to Europe. These are all funds that would otherwise help Vladimir Putin finance his war on Ukraine. Market watchers are concerned about price volatility. Europe will need to replace about 600,000 barrels a day of fuel imports. So who will step in to plug the gap? And will there be enough? Help could come from the Middle East, especially from countries bordering the Mediterranean. India and the U.S., both long-term exporters to the EU, have also stepped up shipments, and China could be boosting supplies as well. But for now, the markets are calm. Buyers in Asia could step in, but the real test will come once the latest restrictions kick in.
Well, that was Bloomberg's Ollie Crook on the new EU and UK ban on Russian oil products, including diesel, which comes to force this weekend. Now, top EU officials are in Kyiv for a summit with President Zelensky today. Let's get more from our Europe correspondent, Maria Tadeo. Maria, a big gesture, but what's actually in it for Ukraine at the summit? And good morning.
Good morning, Francine, to you too. And look, I think you nailed it in the framework of this and the way to frame it. It is a big gesture, political gesture, the symbolic nature of it. Von der Leyen taking essentially all of her top officials to Ukraine for this summit. Yesterday, she laid out the scene in a press conference with President Zelensky, repeating again the way she sees it. Von der Leyen is that this is a war between democracy and authoritarian regimes. She repeated once again the EU will stand by Ukraine, quote, for as long as it takes. And the longer Vladimir Putin denies the existence of Ukraine, the more he will deprive his country of a future. That's for the symbolic measures and the message too, which we know is important in politics. As for the details, we know that Ukraine has made it an aspiration to join the EU, to become a new member of the European Union. They say they're doing their homework, but Francine, behind the scenes, there's a lot of questions and possibly a cold shower. This idea of a fast-track application, a lot of officials behind the scene in Brussels, they tell me it doesn't exist. That's not how it works.
Yeah, it's always a problem of timeline. You're also in Prague today, one of the latest examples of how, of course, the geopolitics of Europe has been transformed by the war. So tell us more.
Absolutely, Francine, from everything to the politics to the energy. And we will be sitting down with General Pavel. He is the president-elect of the Czech Republic. Remember, there was a presidential election on Sunday, winning, promising there will be full support for Ukraine. He is a backer of sanctions. He also says, of course, that the EU should accelerate and potentially look at joining, or letting Ukraine join the European Union faster in the situations that we're in. We're going to be talking about Russia, of course, NATO, and bringing along all of his military expertise, because Francine, he was a big general for many years at NATO. This will be coming up in an hour's time from now.
Maria, thank you so much. Maria Tadeo there with, of course, the very latest on Ukraine, and then that exclusive interview that we look forward to hearing from. Now, we're getting a lot of breaking news data points. Data is what central banks want to see, especially after the communication we had from the ECB, the Bank of England, and, of course, the Fed. First of all, France, January services PMI, pretty much as expected. They're still in contraction because at 49.4 for the month of January. That services PMI from France was expected at 49.2. And then also German services PMI, they just came out, they're actually a touch better. Nothing huge, but we were expecting a 50.4. And again, this is actually expansion territory because it is above 50, but they came in at 50.7. So again, nothing huge, but I guess we'll take any positive in this kind of environment. Now, that's it for the European Market Open. Surveillance Early Edition is up next. We'll look at not only some of the big corporate stories, but we'll look at some of the earnings in the U.S. We'll have a full roundup of what exactly is happening in the U.S. European stocks in general, apart from the FTSE, is dropping. We did have disappointing earnings from Apple, Amazon, and Alphabet, really pouring cold water on the rally that was fueled by investor optimism that rates are getting close to peaking. So we look at that. We also look at some of the big car makers. In the U.S., they did lead the decline, and this is after Ford's fourth quarter profit actually fell short of analyst estimates. We'll have a full roundup of our top stories next. This is Bloomberg.
coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The Adani route continues racing some $118 billion from the group's combined market cap. Shares of the flagship Adani Enterprises plunge 35% at one point, its biggest intraday drop ever. Underwhelming earnings from Apple, Alphabet, and Amazon weigh on market sentiment. It's more evidence that an economic slowdown is throttling demand. Plus, the ECB says to expect another half-point hike next month, while the Bank of England warns that the UK has a long way to go in the fight against inflation. We'll bring you more from our interview with the Governor, Andrew Bailey. The picture for Eurozone, the data. So we are just getting some services PMI coming in 50.8. The preliminary figure was 50.7. It was interesting because we had just half an hour ago the French, that was a little bit worse than expected, and it indicated a contraction, whereas Germany actually came in better than expected, and it was also above 50. The picture for euro dollar is really not moving that much because the focus, of course, here is on the ECB and what Christine Lagarde said in terms of interest rate hikes. The market today, not only looking at central banks, because we did see an initial rally after Jay Powell spoke on the Fed, and markets seem to be, taking that as a very dovish stance that we're reaching the near peak for interest rate hikes. The focus today is actually on earnings. So we had some disappointing earnings, not only from Ford and some of the automakers, which is why we're seeing so much pressure across the board when you look at the industry groups, but from technology companies, including Amazon, Alphabet, and others. The picture here in Europe, so the FTSE really supported by some of the energy stocks. Yesterday, we also spoke to the Shell chief executive, which is why it's not dropping as much as, for example, a CAC 40, a DAX, or a FTSE MIB in Italy. Shares of Adani Enterprises now are paring some losses after a steep drop. The group says it's in talks with creditors to repay some loans backed by pledged shares, as Asia's now second richest man seeks to restore confidence in his sprawling conglomerate's financial health. Meanwhile, global investors are dissecting their exposure to the Adani empire, which has wiped out half of the group's market cap value since a Heidelberg report. Well, joining us now, a Bloomberg opinion columnist, Shuli Wrench. Shuli, thank you for joining us once again. So what has happened to Adani so far? What's the latest?
So there are two different aspects of the Adani enterprise. On the stock side, pretty much, there will be some paring losses, but stocks is pretty much a one-way street going downhill. But on the bond side, it's more interesting in my view because there is a lot of investor-based jostling. So in the last couple of days, based on the prime brokerage reports that I saw, brokers are saying that real money has been selling their Adani bonds whenever there is any whenever there is any rally, and I think they refer to those investment-grade credit funds, whereas they also see that the hedge funds and distressed funds have been buying whenever there is a dip. So basically, you see that on the credit side, more cautious blue chip funds are leaving, whereas more speculative hedge funds are coming in, which makes sense because so far Adani bonds are traded at are rated at the lowest tranche of investment grade, and it's pretty much going into high yield territory.
So, Shuli, is there a contagion risk? Is the Adani fallout shaking investor confidence in India more broadly?
I think there is. I mean, the problem with the Indian market is that it's quite expensive. It's no doubt a very fast-growing marketplace, but everything there is expensive. For instance, State Bank of India is trading at 1 times book. That's higher than, say, China Commerce Bank, Merchant Bank, which is arguably China's best retail bank. And then people are going to ask, you know, like we've been talking about Chinese banks' exposure to bad debt. How about the Indian banks? Perhaps could they have some exposure too? And in that case, do you deserve this 2 or 3 times book value valuation? So I think investors are going to have second thoughts with Indian stocks, especially since China has reopened and it's looking very, very cheap.
All right, Shuli, as always, thank you so much for all of your insights. Shuli Ryan, Bloomberg opinion columnist. Now, we're still seeing, of course, fallout from Adani investors, also digesting yesterday's big day of central bank action. The Bank of England hiked its benchmark lending rate for a 10th consecutive time to 4%. Governor Andrew Bailey explained the committee's decision.
Today, we've increased bank rate by 0.5 percentage points to 4%. So obviously, I want to start by explaining why we've done this. And I'm going to start with the outlook for inflation. Since the November monetary policy report, we've seen the first signs that inflation has turned the corner. Annual consumer price inflation has come down from 11.1% in October to 10.5% in December. That's below where we thought it would be in the November report.
With the Fed and Bank of England sending out signals of waning aggression this week, while after drastic tightening, the ECB's plan for the next big hike makes Lagarde the lost hawk standing.
We intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy. Our future policy rate decisions will continue to be data dependent and follow meeting by meetings approach.
To dig into all of this, we're joined by Sri Kaushal Govindan, Senior Research Economist at Aberdeen. Sri, thank you so much for joining us. Look, central banks, okay, are the one thing that we need to focus on. And there was definitely so much hope in the markets that we would see a Fed pivot. Did the markets almost engineer it, or did they make the Fed sound more dovish than they actually wanted to sound?
I think that's a very good point in terms of how that communication actually came across. Yeah. It was very mixed messaging. So whereas officially they were still talking about the focus on inflation pressures and really talking about, despite the disinflationary pressures, that service sector and labour market's very tight. But it was really the Q&A where we saw some mixed messaging there. And it was the fact that there was less pushback this time. It was less aggressive when questions about financial conditions or, talking about the peak, there was less pushback there, and that was quite interesting. But I'd say that there were mixed messages, and I'd say that going forward, it'll be quite interesting to see the Fed speeches later this week. So if there is a miscommunication, we'll see that reverting quite soon.
So what do you see? Are they taking a pause also to understand the tightening that they've done so far, which we know lags, right, in terms of timeline?
Yes. I think there is a combination of that, where that was what came across when discussing the financial conditions, which have eased and are easing further now in response to this speculation about a pivot. But we do think there's going to be another 25 basis points to go in the next meeting. But even then, we expect rates to remain quite elevated over the course of most of this year, even if there is a slowdown in activity and if there is a recession risk. So I think, yes, they do have a fine balance at the moment. We're close to the peak, and they do need to account for the fact that the monetary policy works with lags.
So is there again a worry that the market misunderstands, even if you're close to a peak, it doesn't necessarily mean that you start cutting?
Exactly.
And this is what the market is starting to price in. So are we going to see a readjustment in yield curves to really make sure that they understand what central banks are saying?
I think potentially yes. I think markets are going to be adjusting according to communication and according to data. Really the data we need to be following would be specifically the labour market data, not necessarily inflation indicators now, but really looking at the details within the service sector. Quit rates are still high across the service sector. So looking at the details there, we do think there's going to be easing, but primarily over the course of 2024. And I think that could be quite aggressive, actually, as we move into next year.
If you look at, specifically at the UK with a tight labour market, how difficult is it to go to that 2% inflation target?
Yes, we think it is. I think US and UK have that in common, with the sense that you have that restriction in labour supply, and the wage increases have been quite strong, and that was really coming across in Andrew Bailey's press conference yesterday. So we think it could be a much slower pace of disinflation is going to be quite strong. From base effects from commodities and from supply chains improving, but again, it's that labour market pressure. The service sector, core services are still quite elevated there. We do think there's going to be disinflation, but return to target, there is a risk that it could be slower than that's currently forecasted.
Do you think there are question marks over China's reopening and the effect that has on inflation, so imported inflation?
Exactly. So that's one of the key risks that we've been studying, actually, recently. So with the labour markets, that's the second key risk. We do think that China reopening is going to be very service sector led, and that will be an increase in domestic travel. We're already seeing that increase in the data, potentially some tourism. So that could be a boost for fuel demand. That would be the main area there. In terms of other areas of the economy, we'll wait and see what happens with the infrastructure. Obviously, if there's a pickup in manufacturing, then that could be quite a big change for industrial metals. So that's something to watch. But I think the local government spending is going to be more focused on fiscal rather than boosting at the moment.
Sri, thank you so much for joining us. Sri Kotri Govindan, Senior Research Economist at Aberdeen, joining us on all the central banks this morning. Coming up, tech shares slide in late trade after Apple, Amazon, and Alphabet report downbeat earnings. More of that story next, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
As a result of a challenging environment, our revenue was down 5% year over year. We remain confident in and focused on the long-term opportunity.
As I address directly the North American stores questions, I think our, probably the number one priority that I spend time with the team on is reducing our cost to serve in our operations network.
The CEOs of Apple and Amazon, Tim Cook and Andy Jassy there, speaking after disappointing results for big tech this earnings season. Now, joining us now is Bloomberg's tech reporter, Aggie Cantrell. Aggie, good morning. So what's overall the big takeaway from these real lackluster results?
The overall takeaway from it is essentially what Tim Cook said, that Apple is not immune to the macroeconomic headwinds, be those inflation, coronavirus pandemic lag, or for instance, things like the war in Ukraine and the consumer sentiment drop. And so essentially what we're seeing across the board, not just from Apple, but Alphabet, Amazon, and other tech companies as well, is that these companies were buoyed during the pandemic, during the last downturn, where other companies were really rocked by a drop in consumer sentiment, but that consumer sentiment was driven to these companies. People were spending more time online, which drove digital ad spend, and also they were purchasing more tech as opposed to spending that money on experiences. And so now this shift is essentially these companies saying, we pushed forward during the pandemic, we made a huge amount of money, we had record gains, and now we're having to retrench and make sure that we're efficient so that we can be sustainable long term.
So, Aggie, should we have seen Apple's revenue drop coming?
I think that's a definite yes on the part of Apple, because essentially we've been seeing this coming for the company. We've seen the issues that they've had getting products out of China, with issues around China's continued COVID constraints, and also when it comes to their delays on launching new products. They are really reliant on these hardware sales, especially over the holiday period. And this year, without launching those products and delaying that, they essentially made sure that they were going to have lackluster sales over the holiday period.
So how is Alphabet and Amazon, how are they trying, Aggie, to insulate themselves from headwinds going forward?
Alphabet and Amazon are two of the many, many tech companies that have announced huge job cuts. These are companies that had added many, many workers to their headcount during the pandemic, during those boom times, and now they're pulling back. And they're both communicating profitability as their main priority. As we heard from Andy Jassy in that clip you just played, their focus is always about costs and about keeping those costs under control and making sure how they're able to have a profitable business going forward. Also, a notable aspect on Alphabet's part is that they are so focused on needing to compete with the likes of Microsoft when it comes to AI. At the moment, Google has been focusing on AI, but very much still in the research phase. And I would expect that with the announcements of the relationship between Microsoft and OpenAI becoming so much deeper relationship, then the likes of Google are going to have to bring their own AI products forward onto the market.
Okay, Aggie, thank you so much, Aggie Cantrell. Looking sharp, I have to say, in like noir and rouge. It reminds me of the old Stendhal book, so we should read it and then twin some more, Aggie. I'm looking forward to that. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Pentagon is tracking what it says is a Chinese surveillance balloon that lingered at high altitude over the western United States. A senior defense official says the balloon was first spotted earlier this week over Montana, home to American ballistic missile silos. President Joe Biden was advised against shooting it down because of the risk of falling debris. Now, the border between Hong Kong and mainland China will fully reopen next week for the first time in 3 years. China says it's cancelling pre-arrival PCR tests and the daily quota for travel across the border. However, a 48-hour pre-arrival test will still be required for visitors to Hong Kong who have been overseas within 7 days. Bloomberg has learned that hedge funds are now being targeted in a U.S. investigation into the use of WhatsApp and other messaging platforms for conducting business. Sources say the SEC has asked firms for evidence to determine if apps are being used to hide deals from compliance departments. It is already fined banks more than $1 billion for previous violations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine, I missed the memo on a red jacket.
Almost, Leanne. We're so close. We'll twin on Monday. Coming up, the Bank of England signals the fastest pace of rate hikes in 3 decades may be drawing to a close. Our conversation with the Bank of England Governor Andrew Bailey. That's coming up next.
Will a slowing economy finally hit the U.S. job market?
The real test for the bear case seems to be jobless claims.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Have we returned to pre-pandemic labor force?
You could see jobs go down to, say, sub 100,000 in the next couple of months.
That'll get their attention on Wall Street.
The January Jobs Report, today on Bloomberg Television and Radio.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture down.
The BOK is getting ready to make a decision. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of England voted to raise interest rates by 50 basis points, lifting the UK's benchmark rate to 4%. Well, Governor Andrew Bailey spoke to me yesterday following that decision.
We don't have a view on the neutral rate which actually shapes our decision-making at the moment. And the reason for that, you might say that's an interesting thing for me to say, but the reason is that there is such uncertainty at the moment. In the landscape that we face. We've got very big moving parts. We've had very big shocks, and particularly very big shocks on the supply side.
But if you look at the market reaction, so you hiked by 50 basis points, and the market is taking this as a dovish message. Are they right?
Well, the market, of course, was expecting us to hike by 50 basis points, so I don't think they will have been surprised by that. I think the market will also be focused on what we do next. And they will have seen some change in our language, and that's deliberate. I mean, that change is obviously deliberate. The way I would interpret it is to say, we are going to react to the information and the evidence that we see. We haven't pre-announced an intention because we have reached a point. As I've said before, I think we have started to turn a corner. That's encouraging. There's a long way to go, and there are a lot of risks.
How soon do you think we'll see a cut from the Bank of England?
We're not in position of speculating on that at the moment. That's off somewhere in the future.
What? Not this year.
We're not speculating on when it is. I say in the future because rates do go up and down in the long run, but we have no date in our speculation.
Governor, we've heard a lot from the Bank of England about the many shocks that this economy is facing.
Yes.
What's the prescription to fix this longer term?
Well, I think there's a number of issues that come out of them. Obviously, some of those shocks are external and relate to, very sadly, obviously, the war in Ukraine, which is terrible. We are beginning now to see energy prices come down quite rapidly. Food commodity prices have sort of seemed to have reached at least a level, but it's not coming through yet in retail food prices. So obviously that's important. Europe has had a much better winter from the point of view of energy than I think people feared, so that's important. And then domestically, labour supply is the big issue, I think.
Does getting closer to the EU change that? Does it change the trajectory for the UK economy?
In the context of the EU?
In the context of Brexit?
Well, I think what we would identify is at least three big shocks that we can see. There's been COVID, there's been energy, and there has been Brexit. It's very hard to separate them out, but the judgment that we've sort of reached on a rather tentative, but I think the evidence is pointing that way, is that we identified that there would be a shock to UK productivity from the reduced openness of the economy. We thought that might emerge over a rather longer period. On our latest evidence, it's probably going to emerge over a rather shorter period and possibly by the end of the forecast's horizon, so look forward 2 to 3 years.
Our conversation with the Bank of England, Governor Andrew Bailey there. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. Coming up, we look at, of course, not only government spending, but Sanofi, those shares sliding after forecasting slower profit growth on the back of vaccine weakness, while we speak to the Chief Financial Officer, Jean-Baptiste de Chatillon. That's coming up next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I'll try and play that role.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
Well, the Adani route continues, raising some $118 billion from the group's combined market cap. Shares of the flagship Adani Enterprises fell 35% at one point, its biggest intraday drop ever. Underwhelming earnings from Apple, Alphabet, and Amazon weigh on market sentiment. It's more evidence that an economic slowdown is throttling demand. Plus, the ECB says to expect another half-point hike next month, while the BOE warns the UK has a long way to go in the fight against inflation. We'll bring you more from our interview with Governor Andrew Bailey. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. Also, happy Friday. It's been quite a week between the central banks and the earnings. I'm Francine Lacqua here in London. So Sanofi shares lower this morning after the French drug maker forecast slower profit growth on the back of vaccine weakness and competition from generic medicines. Well, joining us now is the Sanofi Chief Financial Officer, Jean-Baptiste de Chatillon. Mr. de Chatillon, thank you for joining Bloomberg this morning. What are you most worried about in the next 12 months? Is it government spending, or is it just a pickup in demand for some of the vaccines, but drugs in general?
Thank you very much for having me this morning. Well, really, I'm not really worried. You know, we've just delivered on 22 quite exciting results with 7% growth of the top line in 22, above 17% EPS growth, and we hit our target of 30% BOI operational margin in 22. So those results show that we are fully in accordance to our trajectories that we committed to in 19, and yeah, not much to worry about, especially as Sanofi has a very specific sweet point, is that 23 is the very last LOE, major LOE in our portfolio for many years to come. So we will enjoy steady growth in the years to come. Of course, 23 will be impacted by the Aubagio LOE, but behind the scene, it's clearly a very positive trend for the years to come of growth.
Okay, that's really interesting because we are seeing a bit of pressure on your share price, almost 4% lower on the back, of course, of the slowdown in profit growth. Talk to me about M&A. So we know that you've made some plays, but in the next 12 months, is there anything that you want to acquire in a specific part of your industry?
Yeah, well, M&A is a clear part of our capital allocation. You know, our first allocation is internal investment in science, in our own pipeline. Then it's to invest in BD on M&A deals. And we just did in the last 2.5 years, 25 of those deals to replenish and augment our pipeline. And we aim to go on doing this. Our priority investment TAs are well known around immunology, where we aim to be the leader in the coming years in immunology, but also rare and potentially oncology. So that's where we are really looking to go on investing as we did in the previous years.
Can you give us an update on, for example, sales forecast for Dupixent? So this is your asthma and skin drug. I know some analysts expect it from 13 billion now to come to 18 billion by 2030. Is that the case, more or less?
Well, thank you for asking, because Dupixent is an incredible drug. And it's not just one indication, but it's multiple indications, and we are continuously adding new indication to this on the base of this product. Today, we are already the leading brand in respiratory in the US with Dupixent, and we are now mentioning that we will hit around 10 billion in 2023 with Dupixent. We also mentioned a waypoint of 13 billion without giving a precise year, but it's only a waypoint. And this waypoint doesn't include COPD. We are waiting for a readout for Dupixent in 23 about COPD, which could add a very significant upside to this forecast. So yeah, this drug is just at the beginning of its growth.
Mr. de Chatillon, what's your relationship like with a lot of analysts or shareholders? So there is an underlying worry, I guess, that you're a little bit too reliant on Dupixent, but you also have some pretty incredible drugs. I'm thinking of Beyfortus, I'm thinking of Altuvio, so one is for hemophilia, the first one was for the respiratory virus. What do you think analysts are underappreciating at Sanofi right now?
Yeah, that's a very good point and a very good question, because I think those two launches we are going to execute in 23 are very important proof points. We are going with Beyfortus to bring to hospital patients, babies, and all infant protection for RSV. This is a first. This is a first in disease. This is an incredible possibility to really have a great impact for this RSV. You've just heard during this season, it was super impactful. It is the first cause for babies to go to hospital is RSV. So this launch will mark the beginning of a growth driver for Sanofi. On Altuvio, hemophilia A, is a game changer. Is really a game changer. Why? Because you can have a normal life for 4 days of your week with a weekly dosing, which is really a rupture, really a big improvement for hemophilia A patients.
So you believe these are game changers, but do you think investors are not appreciating that yet? Or do you think there's an unfairness in how they value and look at the company?
I would not talk about unfairness, and I think it's a journey, and we have to go on investing in our pipeline steadily to be able to bring more proof points. You know, Altuvio was nowhere just 3 years ago, didn't exist, and we developed it, and now we are bringing it to market. We need more of those proof points to gain the support and the momentum. You know, short-term trading is not significant. I'm really looking at the perennial growth of the company for the years to come, and we are absolutely determined to deliver on this growth.
Talk to me about some of the litigation surrounding Zantac. So, you know, shareholders frankly freaked out when this came out. Your share price, I think on the day, was down 10%. Do you think now you're over the worst? Have you paid like 80%, or are you expecting still more bad news on that?
Let's be clear. There was first, as you know, science doesn't support the plaintiff allegation, and there was a very important court judgment which was rendered with a Daubert case, which has really clarified things and confirmed that there was no link between this product on the allegation of the plaintiff. So since then, we do think that this Zantac shadow is going to diminish over time, and it's not really changing anything to our strategy nor to our execution. We are really looking ahead and looking to go on developing this growth. I just mentioned 2 launches, very important ones, 2 important readouts, COPD and tolebrutinib in 23, and we are, as we are now, with 27 readouts to come in the next 18 months. This is a great position to be in, and that's where we want to be, investing in science and bringing innovative drugs to patients.
Thank you so much for joining us, Jean-Baptiste de Chatillon, there, the Sanofi Chief Financial Officer. Now, we're also getting a bit of breaking news data out of the UK. We did have services PMI for the Eurozone as a whole. We had them for France and Germany individually as well. Now it's the turn of the UK. On the back of that, you can see cable 122.31. That January services PMI came in a touch better than expected, under 50, so we're still in a contraction territory, but coming in at 48.7, so close to 50 instead of 48. Coming up, we discuss the impacts of the Adani crisis to the broader Indian economy. Nandini Ramakrishnan from JP Morgan Asset Management joins us next, and this is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Fundamentals of our company are very strong. Our balance sheet is healthy and assets robust.
I think whatever blip is there on the stock market and whatever the on the stock market is not going to affect the overall economy.
Investors will look through the short-term noise.
We can't comment on clients, as you know, but I wouldn't worry about it.
Once the current volatility phase settles down, India's sound macro fundamentals, because that's what I said, we are pursuing responsible growth, and that will come through.
Once the market stabilizes, we will review our capital market strategy.
Well, our guests this week weighing in on Adani's record sell-off after the Indian group of companies was accused of fraud. Well, Adani has refuted the allegations. Staying with that story, and Adani Group says it's in talks with creditors to repay or prepay some loans backed by pledged shares, which Bloomberg has learned could happen as early as this week. Now, while global investors scrutinize their exposure to the Indian giant, Gautam Adani's decade-long ties with the Indian Prime Minister Narendra Modi have also come under the spotlight. While the billionaire's investment is heavily embedded in Modi's growth agenda, including multiple capital-intensive projects such as airports, power plants, and of course data centers. Now, we're now joined by Nandini Ramakrishnan, macro strategist for emerging markets and Asia-Pacific equities at JP Morgan Asset Management. Nandini, always great to speak to you.
Nice to be back.
Thank you so much for coming on. When you look at, first of all, valuations of a lot of the Indian companies, is there a global freak out, or certainly many questions about what Adani does to the Indian market as a whole?
So for the market as a whole, India has always been an expensive market, so it creates a bit of discussion on finding sort of those bottom-up opportunities. And actually, this recent episodes in the Indian market are a lesson in kind of that valuation discipline plus bottom-up insights. So knowing where you can pick the best companies that have those kind of rigorous balance sheets and qualities that you want to stick with. So I wouldn't say it changes our broader view on the asset class, and actually, might create some opportunities with the broader Indian market when you think about a stock selection process.
So is this something that could be systemic? I've heard parallels, rightly or wrongly, with Evergrande, and I don't know if there's any truth in that.
I wouldn't say we're concerned about the Indian market as a whole. We have a rigorous research process that looks at the financials, the exposures of other companies in India. So on the whole, I think we're still looking at India as one of the better long-term growth stories in emerging markets, and actually has some of the better, really great demographic potential, consumer potential. So I would say India is still one of our most interesting long-term stories in emerging markets.
So tactically, what do you buy in India?
In India, well, for now, I think it's looking at things like financials that have that sort of penetration growth story. You can also look at consumer companies that have that long-standing history in India that could grow based on the just really excellent demographic story there. So there's a few different sectors and options within the market.
Nadine, when you look at China and the reopening in China, because China is so much cheaper, does it automatically make you compare the two countries?
Yeah, definitely. If looking at EM across the countries, China is certainly one of the more attractive ones. You've got not only valuations on your side with China, but also the reopening story, which is not done, in our opinion. There's three phases we really think. The first is that kind of entertainment, travel, leisure, restaurants, but then you've got delayed purchases. Chinese consumers have saved a lot of money over the past 2 years. They're ready to spend it on furniture, autos, maybe even some home decor, white goods. And then you've got this third phase, which actually might stick around for a lot longer, which would be behavioral changes. So more online services, thinking about prepackaged foods that save you time and money. So there's quite a lot of stories still for the China reopening, we think.
How much inflationary is that for the rest of the world? Well, for China first and then for the rest of the world.
Well, luckily, China's the one place inflation is under all targets or sort of any risk right now. Of course, there's two issues. One is commodities. So increased movement and demand may cause commodity prices to rise, but we think there's still capacity globally to handle that without a huge inflationary spike across the world. But for China, we should expect a little bit of inflation after 2 years of not much consumption. There's going to be almost 8% consumption growth over the course of this year. That's going to come with some domestically produced inflation, and for now, that's fine. I think the PBOC will be watching that closely.
Nadine, overall, when you look at the Fed, of course, the dollar, which a lot of analysts are expecting to weaken, changes everything for emerging markets. Like, what did you learn from Jay Powell this week?
Yeah, well, this is one of actually the key factors for us in feeling like the stars are aligning for emerging markets. The dollar has come down massively from the October peak, and what that means is actually emerging markets, both from a sentiment point of view, but also when thinking about earnings coming into emerging markets, feeling stronger as an investor when you translate that return back. This should be an overall a very good year for emerging markets compared to last year, where the dynamics were totally different with the dollar and the Fed tightening.
But you're convinced that actually dollar can only weaken from here?
Well, the valuations are still a little bit more than expensive. We think 8% above fair value. So in that time, for this year, maybe there's a 2 or 3% depreciation. If there's something that's not in our base case, but let's say a really bad, worse recession in the U.S. than expected, or the Fed has to continue to raise rates after what we think might be a peak in the spring, then there is some strength for the dollar. But overall, we think the directionality is lower over this year.
So how do you play China?
Well, for China, it's looking at that reopening trades, which I discussed, the kind of phases of reopening. And
so sectors.
Thinking, in terms of sectors, obviously you have the local leisure, hotel, entertainment, some of the casino names we still think have room to run. And in terms of medium term, thinking about which specific parts of the kind of delayed purchases sectors will be. There's a range of them, whether it's dental treatments to, let's say, home furnishings that haven't been able to be purchased yet. So those are the kind of sectors that we are looking at in China, and as usual, having a bit of valuation discipline on those, because unfortunately, there is still some price appreciation that's happened over the past few months, so you want to be careful about where you're picking.
Any other, I guess, plays where either stocks look cheap in other countries in that region?
Well, we look at Korea and Taiwan as well, where valuations are extremely supportive. So we think, thinking about the exposures in North Asia and Southeast Asia that are geared to China. So as an example, any Korean exporters will be set to gain. Thinking about also kind of more traditional kind of travel and tourism in Thailand, for example. So there are a few plays you can do within the region that make the emerging market space very interesting.
Nandini, thank you so much for joining us today. Nandini Ramakrishnan, they're macro strategist for emerging markets and Asia Pacific equities at JP Morgan Asset Management. Now, coming up, taking a victory lap, Cathie Wood's funds had a scorching start to the year, and she wants investors to know it. More from our conversation with the ARG chief. That's next, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
For years, Russian refineries have been the EU's biggest fuel supplier, but no longer. New penalties plus existing curbs on crude could cost the Kremlin $280 million a day. And on top of that, Russia is significantly cutting gas exports to Europe. These are all funds that would otherwise help Vladimir Putin finance his war on Ukraine. Market watchers are concerned about price volatility. Europe will need to replace about 600,000 barrels a day of fuel imports. So who will step in to plug the gap? And will there be enough? Help could come from the Middle East, especially from countries bordering the Mediterranean. India and the U.S., both long-term exporters to the EU, have also stepped up shipments, and China could be boosting supplies as well. But for now, the markets are calm. Buyers in Asia could step in, but the real test will come once the latest restrictions kick in.
Well, that was Ollie Crook on the new EU and UK ban on Russian oil products, which of course comes into force this weekend. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Bridgewater has named Karen Carneal-Tamble as its third co-chief investment officer. She's the first woman to hold the top investing job at the world's largest hedge fund. Bridgewater is bulking up its management less than 4 months after billionaire founder Ray Dalio stepped down as one of the co-CIOs. Now, self-exiled Hong Kong activist Nathan Law says he expects people who left the city for the UK to stay there long term. He says that will bring economic benefits for Britain. 2 years into the UK's visa program, he told us he expects more Hong Kongers to leave the city.
We need support to preserve the things that we think that is going to counter China's narrative. For example, our preservation of our culture, our identity, our advocacy is crucial when it comes to whether we can have thriving and a strong Hong Kong overseas community.
Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thanks, Leanne. Kathy Wood's funds had a scorching start of the year, and she wants investors to know it. The ARK Investment Chief Executive Officer, who is known for making bold predictions, spoke to Bloomberg TV.
One thing that happened last year is we were able, with a number of papers, we called it our ground war. We were trying to help investors and advisors understand that if you take a look at truly disruptive innovation, which is all we do, and you look at other growth portfolios, large cap growth, growth generally, as well as the major benchmarks like the NASDAQ, you won't find much truly disruptive innovation in them. And so as we were getting hit so badly, what we also saw is investors taking tax losses in some of NASDAQ and other strategies and moving into our strategy, which was hit so hard because they did believe that we were going to rebound faster. We were hit the hardest. Our research would suggest that the $200 trillion that we expect by 2030 to be the market valuation placed on disruptive innovation, that hadn't changed. That hadn't changed. And so if you have a 5-year investment time horizon, yes, you move into our strategy. And oh, by the way, we are the new NASDAQ, which is one of the ways we were trying to convey, look, if you want to look at the future and truly disruptive innovation, the way the NASDAQ performed in the 80s and 90s, that's where we went for innovation. Okay, look through that now. You will not find the kind of disruptive innovation. It certainly doesn't dominate those indexes, maybe 25% of them.
ARK Investment Management Chief Executive Officer Kathy Wood speaking to Carol Massar. Now, this is the picture for the markets right now. We did start on a low on the back of some disappointing earnings in the U.S., the trio of Alphabet, Amazon, and others. U.S. 10-year yield 3.3940. Good job, everyone. You've made it to Friday. It's been a pretty hectic week in terms of central bank action. It started with Jay Powell, and this is on the back of earnings as well. So we'll look at, for example, cable 122.39. There's a bit of a debate on the market now. Do we have another 25 basis point hike from the Bank of England next month, and then that's it, or is that it now? Euro dollar 109.27. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
There's been, in our view, a pretty significant paradigm shift from the kind of economic environment that we had for the last 40 years to where we're going this year and next and the decade ahead.
Concern around wage pressures, inflation becoming more entrenched, how central bankers talk about second-round effects. So I think it's a very difficult balancing act at this juncture.
I would not be surprised to see the Fed cut rates this year.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The latest U.S. jobs report is out a few hours from now. The labour market may be cooling down, but will it be enough for the Fed? Tough times for big tech. Apple, Amazon and Alphabet post results that show the economic slowdown is hurting demand for some of their products. And a brutal sell-off gets worse. Gautam Adani's empire has now lost more than half its market value since that report from short seller Hindenburg Research. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, it's one of those weeks where you have absolutely no time to look back. Fed, Bank of England, ECB, all of those are done. Big tech, done to some degree. And now we look ahead to the jobs report.
It has been such a busy week, Anna, but of course, Asia had a lot of catching up to do overnight from what we saw in terms of those big three tech reports after the bell yesterday. So as a result, you did see tech shares under pressure in Asia as well. The Hang Seng Tech Index in Hong Kong, for example, one of the underperformers, down about 1.3%. And then there is other macro stories, of course, that Asian markets had to catch up to, including the central banks that Anna was mentioning. We saw a huge rally in the bond market off the back of the ECB and BOE yesterday, and Australia was playing catch up to that. The 10-year yield there down 16 basis points overnight to 338. But of course, the more micro story in Asia that we're watching, and specifically in India, continues to be Adani Group. It has been a wild trading day for the flagship Adani Enterprises. It was down as much as 35% intraday at the low point of the session. Then it was in positive territory by about 7%. Right now it's down about 2%, higher by 2%. Now it's literally changing in real time. A lot of big trades seem to be going on, but still, you cannot almost overstate the pressure that has been on this conglomerate. As Anna mentioned, Matt, over the course of just the last 6 trading days, really since that Hindenburg report came out, we've seen about half the market value of these companies wiped out.
All right, but interesting that it seems to be bouncing now and turning back around a little bit. We'll continue to follow that big story. Take a look at futures. We are down almost 1% on S&P futures, but yesterday in the cash trade we gained 1.5%, 3.25% on the NASDAQ. So big rally yesterday caused by the perceived dovishness of Jerome Powell and the Federal Reserve, as well as other central banks, and the big beat by Meta, or really the cultural tone shift at Meta that is going to be cutting costs. We have yet to factor in to the cash trade, obviously, what we see at the 3 A's, and we'll talk about Amazon, Alphabet, and Apple today. The U.S. 10-year yield coming up just a little bit, but still under 340 right now at 339.40, going out 5 significant digits. And NYMEX crude, although it's up, still with a 76 handle. So this looks like recession concerns are priced in. We had seen, remember, at the start of the week, more than $80 a barrel for West Texas Intermediate, and Brent was up there at 87, 88. Now we're looking at Brent, I think, around 81, 82. Anna's going to show that to you in just 1 second. We do see Bitcoin at 23,421, so it's holding over that $23,000 level, but off from the close over, well, there's no close, but off from midnight last night. Anna, what do you see in terms of the European markets?
Yeah, well, it's incredible, isn't it? The whirlwind we've been on in the last 24 hours or so. Matt, you're right to point to that story yesterday, the Meta story, and the perceived dovishness of central banks really lifting stocks around the world, including notably on the NASDAQ, but also here in Europe. Today is a different story. We factor in the negativity around big tech, the disappointment from those 3 A's, and we'll get more details on that story. And then later, we're going to look back to the macro story. We're going to look ahead to the jobs report. So there's so much going on, a bit of a tech wobble for some European markets, others being held up by some resilience in oil prices, we should say. Infineon then in focus for 2 reasons. Firstly, because of the fact they reported numbers. So the profits themselves coming in positively, better results than had been expected, actually guiding higher this business because of strengths in the auto sector. Although they do, this is a chip maker, of course, they do acknowledge that end consumer markets are looking pretty weak. But add into that the Apple story and the negativity around tech, and we see Infineon down 0.7%. Over in France, in the pharmaceutical space, this company, Sanofi, is down by 2.4%. And this is a business that issued some soft guidance, generic competition, a real issue for this company. Euro dollar checking in where we are, 109.27, not an enormous move all told. After that ECB meeting, we heard from one side of the trade, we heard from the Fed, then we heard from the ECB, and we haven't gone all that far, but just checking in on where we are. We saw strong risk aversion and money going into the dollar earlier on, but now we seem to see a little bit more resilience and the euro fighting a little bit of its way back. We've heard from some of the hawks this morning at the ECB out on the wires talking. This is the UK 30-year yield, and I put this in. I could have put the German bond market, I could have put the Italian sovereign debt story, because really we saw these moves across Europe yesterday, and today continues to be a pushback against those. So yields yesterday on this particular 30-year gilt down 19 basis points. So the fact that we're up 5 or so today, keep in mind that we're really just unwinding a little bit of that move we saw yesterday. Again, back to that dovishness from central banks, Matt.
All right, we'll continue to watch what's going on in central banks, especially as it regards the U.S. labor market. We're going to get a jobs report today, likely to show that that market continued to moderate at the start of the year. Still, wage growth, a historically low jobless rate, and high vacancies, I should say, vaccines, are expected to keep the Fed from lowering interest rates for some time. Michael McKee, fully vaccinated, Bloomberg International Economics and Policy Correspondent, joins us now. Yeah, 11 million vacancies. It's pretty unbelievable.
It has got Wall Street thinking that we're going to have an upside surprise today. The whisper number 198, which is significantly higher than the 189 that is in the official forecast. But that's the least important number out today. We've got a lot of other numbers in the jobs report that are going to matter more, because it's all about telling a story. The story is that the job market is slowing down, so we're expecting a slightly lower rate of job creation. But unemployment has not gone up, and that was a key question for Jay Powell at his news conference. What's the deal? And he seems to think now that maybe it doesn't have to go up as much as the Fed had forecast in December at their last meeting before this week. Average hourly earnings, though, that's the story of the day. 0.3 gain for the month and a 4.3% annual rate. On an annualized basis, we are closer to that green line there. That's the line that the Fed thinks is acceptable in terms of wage increases is compatible with a 2% inflation rate. So we've still got some ground to cover, but we're getting there. So Wall Street's going to be watching that to see if we make the kind of progress that they're looking for.
Well, it'll be interesting as well for people just watching the headlines to contrast what could be a strong payrolls report against so many headlines we seem to see each and every day about another company announcing layoffs. I believe there's been more than 100,000 job cut announcements already this year in terms of the number. When do we expect those to actually show up? Because it's not going to actually be in the January report.
No, it's probably not going to be in the January report. We're looking a couple months out. The idea of mass layoff notices, giving people 60 days notice, doesn't always come through, but it probably has a big has a lot to do with why we're not seeing the numbers now. The interesting thing is going to be how do the unemployment numbers affect what the Fed thinks is going on, because if people have jobs, and as Matt says, if there's that many job openings, then that puts upward pressure on wages in theory. But wage pressures are coming down, and we still have a lot of openings. The Fed thinks, or said in December, that we're going to have 4.6% unemployment this year. We're still at 3.6. So do those two lines converge? That's going to be kind of the question, because if they do, then maybe we don't see wages go up as much.
Mike, thanks very much. Michael McKee with the analysis of the jobs report. And Mike will be bringing you the jobs headlines at 8:30 a.m. Eastern Time. And we'll hear from the Labour Secretary, Marty Walsh, as is traditional, on Jobs Day, 9:30 a.m. in New York, 2:30 p.m. in London. Now, on to tech shares. Another story dominating trading today. Tech shares are sliding after Apple, Amazon, and Alphabet all reported downbeat earnings. The results show an economic slowdown is hitting demand for electronics, e-commerce, cloud computing, and digital advertising. Apple CEO Tim Cook spoke about the company's sales miss.
As a result of a challenging environment, our revenue was down 5% year over year. We remain confident in and focused on the long-term opportunity.
Let's get to Bloomberg Quick Takes, Alex Webb, who joins us now. And Alex, I mean, focusing in on Apple then there for a start, it had everything really in terms of the headwinds that this business has been facing, from FX concerns to supply chain to end user lack of enthusiasm. What stood out to you?
I think it was the fact that they kept on saying, well, there were supply chain issues, right? That we know that factories in China haven't been able to operate at full capacity, but tagged on the end of that, there's always, and also macroeconomic headwinds, which is ultimately a euphemism for not enough demand. And the question that investors are really asking right now, and why we're seeing some of the doubt big doubt clearly creeping into the share price, how much of it is demand, how much of it is supply? Previously, they've had supply chain issues. They've said, we still expect the demand to be there in a few months' time for the next generation of the iPhone, whatever it is. Right now, there's questions over whether that exists and how long it will take to recover.
Yesterday, we saw investors who were happy enough with Facebook making a switch from growth to cost cuts, as long as they're shoveling out cash, right? Buying back $40 billion more shares. Are these any of the AAA companies having to do that to appease investors?
Well, they haven't made similar comments just yet. There was the thing that really stood out with Facebook, as they were emphasizing this change of culture, that this is going to be a year where they're really actually going to focus on costs in a way that they and a lot of the other tech companies haven't really had to do for much of the past decade. We've also seen, though, that Facebook has been trading at a significant discount to all these companies. Back in November, it dipped below a 10 times multiple of forward earnings. It's still at about 16 times forward earnings. Apple's up there at 23, 24. So there was massively low expectations with Facebook. That means that a little bit of good news, a change in the sentiment, the way that the managers are describing their business was therefore taken well by investors. That has not been the case with Google, Amazon. Google's saying that their CapEx is going to stay flat this year. Facebook being a little bit more circumspect, saying actually CapEx is lower than we thought it was, than we had previously telegraphed it's going to be.
Alex, thanks very much. Bloomberg Quick Takes, Alex Webb with the latest on the tech names. A real focus for markets, and US Nasdaq futures down by 1.5% this hour. The pressure on Gautam Adani to address concerns over his conglomerate's financial health is still mounting. The brutal stock rout in Adani Group companies has wiped out half of the group's market cap value since the Hindenburg report. Bloomberg's Kriti Gupta joins us now with more. Chrissy, where do we start? I mean, just the news flow surrounding this, the sell-off in the shares just continues, despite the fact that Adani continues to push back and say that the allegations made by Hindenburg are false. I mean, just today we heard from a European energy company, Total Energies, talking about its exposure to Adani. You have to wonder where this ends.
Right, there's so many more places. You had their global sustainability index, for example, really kicking the Adani Group out because of that exposure. The same story, but once again, Anna, the takeaway here is that this is a story of sell first, ask questions later, and that's really where you're seeing about $118 billion of market cap just completely wiped out. And not to mention the short selling even bidding up further. That's really important when you look at some of the options volatility, when you look at what the moves actually are from the share price perspective. But at the end of the day, it's really important to keep in mind that, look, this is a stock that has essentially quadrupled in the last 18 months or so. That is how it kind of came across the Hindenburg report's radar, who claims, by the way, for international audience that hasn't been following the story, that, look, this kind of giant increase is really led by the idea of offshore accounts that are then involved in things like tax fraud, corruption, and of course, a unsanctioned connection to Prime Minister Narendra Modi's infrastructure agenda, something that has really been fueling a lot of the gains in the Adani Enterprises saga.
Of course, Adani refutes those claims. What do we know about what investors want next from Adani? What do politicians want next? What are the next steps?
Yeah, well, so basically they want some sort of confidence, and this is where the debt really comes in handy, because when you look at what the stock market is doing, the stocks have just completely, like I said, wiped out about half of their gains. But the way to kind of enlist a little bit more confidence is to say, look, the debt hasn't sold off by as much as the stock is. So if you prepay those loans, you are then essentially enlisting confidence in the likes of ICICI, which is a major Indian bank, Credit Suisse, other banks that are saying, look, maybe we need to have margin calls. We're not there yet, but that's the fear, and Gautam Adani and his enterprise is getting ahead of it.
All right, Bloomberg's Kriti Gupta following this story. Thank you so much. And be sure to check out today's Big Take, exploring how Adani's crisis is shaking investors' faith in India. Look for that online or on the Bloomberg terminal at NI Big Take Go. Now, though, let's get back to the U.S. markets and take a look at some stocks we are watching in pre-market trading. I have to begin with Nordstrom. 29% move to the upside, and there is one man really to thank for that, Ryan Cohn. Of course, this is a famed meme stock investor. He also, of course, was the co-founder of Chewy. Where he goes, retail investors tend to follow. So news overnight, reportedly, according to Bloomberg, familiar with the matter, that he is now one of the top 5 outside shareholders in this company, pushing potentially to replace a board seat, has this stock flying in pre-market trading. Plenty of stocks are not flying, though, including those that reported earnings yesterday, like Ford. Its profit came up short of expectations. It really shows that this company is struggling to manage the transition from regular combustion engine vehicles to electric vehicles. This stock down about 5% before the bell. And also lower after earnings is Qualcomm, really struggling with the downturn in demand in the smartphone market. So its sales forecast came up short of expectations. As a result, that stock down about 3.4% in early trading, Anna.
Coming up, we're going to talk tech then, Kaylee. Adams Fund CEO Mark Stokel will join us. His top holdings include the tech trio Apple, Amazon, and Alphabet. What does he make of the reports last night? Was he focused on the meta positivity or the negatives around these AAAs? We will also talk to Janet Henry, HSBC Global Chief Economist. We'll take stock of the week that was and look ahead to the jobs report, of course. Plus, we're live in Prague as the Czech president-elect speaks exclusively with Bloomberg about the war in Ukraine.
Ukraine can defeat Russia on Ukrainian soil. It means to push Russian forces out of Ukraine and restore territorial integrity and full sovereignty of Ukraine. I believe that with our support, this goal is achievable. And we should strive to achieve that goal because it's a matter of principle.
life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York and Anna Edwards in London. Now, derivatives shops found themselves in a dramatically different era this week, the old days of manually processing deals. It all started with a cyber attack early Tuesday on ION or Ion Trading UK. It's a little known, I don't even know how to pronounce the name, but critically important software company apparently that underpins the smooth functioning of markets. Joining us now to talk about the results of this is Bloomberg Markets editor Lynn Thomason. So it sounds like this is hugely important and a big problem, but maybe the results are just that kids learned how to write tickets. What's happened?
They'll probably need to hire some more kids as well if this is going to be a common occurrence. I mean, I think it speaks to the worst nightmare for a lot of trading firms and banks on the street, that something like this could be vulnerable to a cyber attack. And, there's always the potential, especially with a ransomware company, that, sensitive consumer data could be exposed, that trading could be frozen. You just really don't know where to go with it.
And we saw some innovation and also some perhaps panic at some of these businesses then, according to our reporting, Lynn, because for some people this represented the worst of things, going back to the 80s and 90s and manually writing tickets or manually inputting into things that look like early web 1.0 sort of devices to do trades. But for others, groups of coders getting together to quickly try and fill gaps and write new code. I mean, that's quite a fascinating insight into the way that these businesses cope when tech lets them down.
Yeah, absolutely. And maybe that's the new reality that we're in, that, there is this vulnerability of the system, that it is fragile, but, the resilience is that coders are able to come together and try to solve it quickly. But it's still a big unknown, and especially, I think, in this day and age where so much of market structure is interconnected and it's so complicated that, a lot of people would say we don't really understand it until it breaks down.
Lynn, speaking of vulnerabilities, we learned overnight that even the largest of big tech companies are not invulnerable to an economic slowdown. They are subject to those same macroeconomic headwinds. That clearly already weighing on risk sentiment this morning before we even get the payrolls report at 8:30 a.m. Eastern time. How much potential does it have to roil market sentiment even further?
Yeah, I mean, I think it's definitely what people are looking for in the jobs report is this Goldilocks scenario, that inflation's not going to be too hot and we're not going to end up in a recession. And, you're seeing that in the market action this week, that we've had this tremendous rally. Today, there's a bit of a pullback, perhaps another view that things have gotten a little overheated. But, in my mind, the big surprise is how much people have been willing to pile back into tech stocks after, the big sell-off last year.
Lynn, thanks very much. Bloomberg's Lynn Thomason joining us there with the latest on this story and the broader markets. For more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. They've been all across all of the tech earnings, the central bank decisions, and they will be looking ahead, of course, to payrolls. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Caitlin Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The Pentagon is tracking a Chinese surveillance balloon that lingered at high altitude over the western U.S. The balloon was spotted over Montana, home to ballistic missile silos. The Pentagon advised against shooting it down because of the risk of falling debris. All this could complicate Secretary of State Antony Blinken's visit to Beijing next week. In the UK, the rail network is being snarled by another mass strike today. 12,000 drivers were set to walk out for the second day this week. Their union warns that more strikes could be announced if talks next week don't lead to a breakthrough. Former Goldman Sachs President Harvey Schwartz is in talks to become the next CEO of private equity firm Carlyle Group. Bloomberg's learned Carlyle board members and shareholders have discussed Schwartz in recent weeks. His arrival at the firm would resolve a long-running succession challenge. And Ford is blaming poor execution and continued supply shortages for fourth quarter profit that missed estimates. The results show the company is struggling to balance the transition to electric cars from conventional vehicles. As a result, Ford will ramp up its cost-saving efforts. Job cuts will be part of that. And we know job cuts also have come for big tech in a big way, Anna.
Yeah, absolutely. Coming up, we'll talk big tech. Mark Sokol joins us, Adams Fund CEO and senior portfolio manager, owner of some of the companies that reported overnight, giving a very different impression of big tech compared to Meta. We'll get into that conversation next. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The latest US jobs report is out a few hours from now. The labour market may be cooling down, but will it be quick enough for the Fed? Tough times for big tech. Apple, Amazon and Alphabet post results that show the economic slowdown is hurting demand for some of their products. And a brutal sell-off gets worse. Gautam Adani's empire has now lost more than half its market value since that report from short seller Hindenburg Research. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, yesterday was all about central banks and about tech. This morning seems to be all about tech. Later, we're going to be all about jobs.
Yeah, absolutely. So we've gone from macro to stock-specific, and now we're going to go back to macro. We are down about 0.9% on S&P futures right now. We had a huge rally yesterday, really. The S&P 500 up to, I think, 4170, somewhere around there. So already higher than strategists are forecasting for the year-end levels on average. We are looking at a 10-year that's coming down a little bit. 338.85 is the level on the 10-year, and crude is coming down as well, 75.82 a barrel. So a 75 handle on NYMEX shows the pessimism that we're looking at for this economy. Really, globally, you see commodities prices that haven't rallied after the reopening of China. So I think that's pretty fascinating, especially considering Europe doesn't look as bad as we may have thought in regards to a recession. Bitcoin is coming down from midnight, but still is above 23,000 at 23,379. So we continue to see strength and really a lack of volatility there. Kaylee, what do you see in terms of the pre-market movers?
Well, I'm checking on AAA. That's what we're calling it, right after their reports after the bell yesterday. Trillions and trillions of dollars worth of market value, and that's going to be less come the opening bell in about 4 hours' time, because we are seeing Amazon, Alphabet, and Apple all under some pretty significant pressure after their results. For Amazon, there is some weakness in consumer demand, but the bigger concern, perhaps, is the cloud division after the company said they do expect growth there to slow over the next several quarters. That's concerning because AWS is one of their big drivers of profit. So that stock is down 5.6%. Alphabet down by about 4.25%. That ad business really coming under pressure as the macroeconomic environment weakens. That's a struggle for Apple too. Weak demand for iPhones and Macs means they just had their worst holiday quarter in 4 years. Sales coming in even more than expected. So that stock is down, bringing all together the QQQ, which is the ETF that tracks the NASDAQ 100, down 1.7% before the bell. When you have a lot of weight dragging things lower, Anna, the broader market is going to go with it.
Okay, so QQQ and AAA in focus as we head towards the US Open. This is what we have for European equity markets. More alphabet, Soupbat, Stocks Europe 600 down by 0.25%, factoring in the overnight news around tech. That's certainly one of the drivers here. We've also got some resilience though in the London market, and that's very much driven by the energy side of things. Financials also, the banking sector not perhaps as badly hit as some others. Tech is a weaker sector today. Infineon is one of those. This is the chip maker based over in Germany, down by 0.9%. Actually, the business itself reported some numbers that could have gone down pretty well with analysts. Their guidance around one of their areas of end consumer, the auto sector, was pretty strong, and so there was an upgrade to some of the guidance they were giving. But they did acknowledge that end consumers in the consumer segment did look a little bit weaker, and so that is weighing, as well as some of the news we had overnight from US big tech. Sanofi is down by 2.8%, the drug maker over in France. That business reporting numbers as well, but generic competition leading to some slightly weaker guidance coming through, and the stock sells off. The UK 30-year yield I put in here, and interesting, we're seeing 6 basis points higher in yields today, but we lost 19 yesterday. We saw some big moves downwards in these yields in Europe. I picked the UK market because that's where the moves were biggest, but also in the German, the Italian debt markets, we saw those yields coming down yesterday, and we see those yields bouncing just a little bit today then, Kaylee.
All right, Anna, well, let's get back to the big tech story here in the U.S. Joining us now is Mark Stokel, CEO of Adams Funds. Mark's top holdings include the tech trio, AAA, trifecta, whatever we want to call it, Apple, Amazon, and Alphabet. He is up early for us here on the East Coast this morning. So, Mark, thank you very much for that. Prior to these results, we had seen a massive rally in these tech stocks so far in 2023. Now that you've seen the prints, is that deserved? What kind of multiple is appropriate for these companies that are no longer growing like they once were?
Well, I think that's probably the most important question to ask, Kaylee, is what do you pay for these? Let's start with all three companies are good companies. There's nothing wrong with their companies, but we try to make at varying levels of expensive. And again, good companies, but are they stocks to own in a big way right now? You know, we think you could probably add to them, which we would like to do over time at lower prices here.
Mark, can you contrast these companies with Meta? Because it wasn't very expensive by a lot of the same measures, but it also managed to give back an extra $40 billion or announce another $40 billion in share buybacks. We didn't see any of those kind of announcements from these companies.
Yeah, Matt, it's a good question because, you know, the Meta, I would describe Meta as being a rubber band that was stretched really, really hard. And so the snapback shouldn't surprise too much. You know, I think that they were the first one to report. And frankly, it seemed to me that Apple, Amazon, and Alphabet all listened to that call because everybody effectively said the same thing. Operating efficiencies, you know, we're going to be more diligent on expenses and those kinds of things. But I think the Meta was surprising to me in that, I mean, effectively they had $125 billion of market cap added to the company, and they really only reduced expenses by about $5 or $6 billion. But I do think that snapback doesn't surprise me that much because it was among, as you just mentioned, among all these stocks, the cheapest by a long shot.
Yeah, they might have delivered similar messages, Mark, good morning to you, to what we'd heard from Meta, but it certainly didn't have the same impact on the share price as you point out. Let me go to the Google story here, or the Alphabet story, and AI. AI got a lot of mention. ChatGPT, you can't move for mentions of ChatGPT across all kinds of media so far in 2023, Mark. How much is this adding to the planning around that theme over at Alphabet?
Well, I think it's adding a lot, but I also think that how would each of us react with a slowing search business? Cloud was fine, but their real engine is search is slowing. So if I'm the CEO, I'm doing exactly what they did, which is I'm going to talk about the next thing, and the next thing for them is AI. You know, I do think that they're approaching this. It appears they're approaching this in a very thoughtful way. They want to be careful about how they enable it, how they roll it out. But I'm not really surprised that they're trying to pivot. And the number of times in the call that the CEO talked about AI was borderline annoying. But I would do the same thing if my big engine, the search business, was slowing.
Well, and Mark, of course, Alphabet is one of the long list of tech companies that have announced job cuts this year. Bank of America put out some research earlier this week that essentially said we've seen 80% growth in employee count for tech companies over the last 3 years, but only a 60% sales growth number over that period. They view that as a 20% overshoot, even if there is no more demand hit from there, which clearly borne out in these 3 results, we are seeing demand slowing down. How much more trimming of the fat do these companies need to do?
I think they need to do a lot, and I haven't seen the Bank of America piece that you referenced, but I will tell you one of the things that that I think is a challenge for all 4 companies, the AAA as you called it, and Meta is the fact that they did get fat, a lot of hiring. It's not in their culture. I mean, these companies haven't come to greatness by worrying about expenses. In many respects, they've had the luxury of having revenue growth really carry all their expense growth, cover all their expense growth. That has changed, and I think that pivot is really hard for these companies. And again, we've seen sort of a little tip of the cap to reducing expenses, but I think directionally, Bank of America is right that there is a lot more they could do, and frankly, a lot more they should have done and should have done faster. To be fair, the reduction in force that Amazon mentioned, the 18,000 people, that's a pretty big number, and I think that they probably did the best job of expense reduction, or at least talking about it. But Alphabet and Apple, I think, really need to do a better job of taking out expenses at a faster rate, even though from a cultural standpoint, that pivot is very difficult for them.
Yeah, Mark, thank you very much. We appreciate your time. Mark Sokol of Adams Funds, thank you very much for joining us to talk about some of the businesses that he holds. Coming up, we'll get back to the macro conversation. Janet Henry will be with us, HSBC Global Chief Economist, and it is a global view you need this week, from the Fed to the ECB to the jobs report out of the US. We'll get her perspective. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York and Anna Edwards in London. Now, U.S. jobs data may show a slowdown in hiring. Estimates say the economy added 189,000 jobs in January. Still, wages are expected to keep rising, and the jobless rate is near a 5-decade low. Joining us now is Janet Henry, Global Chief Economist at HSBC. Janet, what do you think about this labor market? I mean, depending on what metric you look at, it can appear incredibly tight or maybe loosening a little.
It can be argued as loosening a little, and certainly we are hearing headlines about job layoffs and such like. But we've also had a report from the ADP about January. So I think we know that there might be a weather-related effect. The ADP survey-related release suggested a marked slowdown, but you had floods on the west and snow on the east coast. Whereas actually, if you look at the hiring data, still strong, and certainly we think there might be an upside risk to today's release. But as you mentioned, it's the wages number that probably will be most important rather than the job creation.
Okay, and thinking about what links that with inflation then, Janet, I mean, do you think, is it possible to have a situation where inflation does come down back to target, but the jobs market doesn't really move all that much and doesn't crack all that much? Is that something that is possible, or is it one of those, it's simply you can't have that sort of Goldilocks situation?
Well, you've never had it before, is the truth of the matter. But over the last couple of months, the labour market has been fairly firm, and we have seen wage growth moderate. And I think that's what the markets certainly at the moment are hoping for. And to some degree, that is what's built into the Fed's forecasts, that we're going to see only a very tiny rise in unemployment in the coming year, but wage growth will slow and inflation will be able to slow back. But it would be exceptionally unusual. And I think what's been interesting over the last couple of months is that even construction has still been adding jobs. Now, we've been in a residential construction recession for a year, but construction's still adding jobs. Manufacturing is still adding jobs. So we've seen it in the UK that the economy can be almost flatlining, but the labour market still remain quite firm. Maybe it's labour hoarding to some degree, at first signs of slowdown. So I think that the risks in the US is that the labour market does stay a bit stronger, and that we don't necessarily see wage growth continue on a downward track without seeing some rise in unemployment, which obviously will hinge on how much the Fed continues to raise interest rates.
Right, and Janet, to that point, in theory, a strong labor market would raise the odds of a soft landing for the U.S. economy, but I also could see the case that it raises the odds of a hard landing, because if it remains too strong, the Fed needs to go that much harder. Even the terminal rate, if they hang out there for a while on pause, realize wage growth is still fueling inflation, they may need to hike again. How do you think about those two scenarios?
Well, as you say, a strong labour market, it hinges on whether it's job creation or it's actually wage growth. The Fed would obviously love it if we were to see wage growth to return to something that's more consistent with getting back to a 2% inflation target. If we can get, with 3.5% unemployment, wage growth slowing to 3% or below, then maybe they will be confident that we are in this true Goldilocks world. So I think if they're going to focus on one thing in particular, it will be the wage numbers. So today, we're pretty much in line with the market and expecting another monthly increase of 0.3. That would take annual wage growth down to about 4.3. They need to see it continuing to fall on a downward track and not give any suggestion that they are going to change course rapidly. And obviously that's what the market's pricing in, that they will finish raising rates in March, but then have a quick reversal. And I think the message that the Fed's been trying to tell us is that, yes, that might be enough to stop then, but don't look for a quick reversal. They are worried about inflation becoming entrenched, not at 6 or 8%, but maybe at 3 or 4% when their target is 2, and therefore having to keep policy tighter for significantly longer. And I think that's a message we've heard from some other central banks in the last couple of days as well.
Janet, I wonder what you think when you look at the JOLTS numbers or the job openings. of 11 million at the same time as we're, every day reporting news stories of layoffs in the thousands or tens of thousands. Why do you think that number, the openings number, is so high? Is it real?
Well, there's always some concern. You get kind of jobs that have just been advertising for some time and don't get taken down. But hiring was strong as well in those jobs numbers. It was job openings as well as job hirings still remaining quite strong. And I think the difficulty with some of these headline numbers of job losses, a lot of them are made by very, very large companies, many of which did not fire anyone during the worst of the recession. In fact, they still hired quite aggressively, and now there's a degree of catch-up. And we need to remember that most people don't work for these larger companies. A lot of them work for very, very small companies indeed. And I mentioned the construction sector. For a time, you couldn't get a builder for about a 2-year waiting list, whereas actually you are managing to get more builders. Maybe those waiting lists for some of the smaller jobs, even if other broader big areas of housing are starting to slow down, you've still got that demand coming through. So I think what's happening at the establishment level by firm size is quite important to what's happening in these labour markets as well.
Janet, thank you very much. Janet Henry of HSBC, looking ahead to the jobs report. Later today, we will get the White House view on that US jobs report. Labour Secretary Marty Walsh will join us, 9:30 a.m. in New York, 2:30 p.m. if you're here in London. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
This is Bloomberg. Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York. Anna Edwards is in London. We are almost through with a very long week, but first we have to get through this Friday. The big event of the day, as we've been saying, is the U.S. jobs report. That comes at 8:30 a.m. Eastern Time. There's also closing arguments in the Elon Musk fraud trial set for today, followed by jury deliberations. And finally, Ukraine and the European Commission are holding a summit to discuss Kyiv's integration in the bloc, with Ursula von der Leyen and Charles Michel expected to attend, Anna.
Now, speaking of what is happening with Ukraine, the Czech president-elect has been speaking with Bloomberg's Maria Tadeo in Prague about the ongoing war. Maria joins us now for more on that exclusive conversation. Maria, what did he tell you?
Yes, Anna, and we spoke with General Pavel, and I say general because he was a former top-ranking NATO general before becoming a politician and president-elect in the Czech Republic. Remember, there was an election on Sunday, and I talked to him about, obviously, the war in Ukraine and bringing together the politics and his military experience in real combat. I asked him, is it realistic? Is it possible that Ukraine can defeat and achieve a victory over Russia? This is what he had to tell me. Let's take a look.
We see Russia pushing the situation up to the edge quite often, provoking fears in Western democratic countries that should prevent them from continuation of support to Ukraine. I believe that we shouldn't get too scared by Russian escalation. We should stay firm and keep pushing on Russia to respect the norms of international law.
And that was General Pavel speaking, well, just a few minutes ago here from Prague to Bloomberg TV. And beyond that, of course, I also asked him, well, if you look at what is happening today in Ukraine with von der Leyen and all of the European representatives there meeting with President Zelensky, what about Ukraine joining NATO? What about Ukraine joining the EU? And he told me it's a yes, in his view, of course, to both questions. He said, at this point, NATO, well, should be an option for Ukraine. They are NATO compatible in his view. Of course, there's a lot of debate as to whether this will happen hypothetically one day, but when it comes to the European Union, he was even more explicit and told me there's no way you can talk about reconstruction of Ukraine without talking about membership in the future.
Very interesting. He also had some pretty hawkish comments on China. I mean, you don't even have any surveillance balloons floating above you that I can see. Pretty unusual for maybe a small country to make those kind of remarks.
Yeah, absolutely. And you always usually want to play it diplomatically, right, with a country like China in general terms. But it is interesting that as soon as he was elected, he got on the phone with President Zelensky, but he also took a phone call from the leader of Taiwan that immediately provoked a reaction from China, saying that this was a provocation and they viewed this as provocative behavior from the Czech Republic. He told me China does not have a right to tell another sovereign country what to do, who they can get on the phone with, and what they can say. I also asked him, in your view, is China a friend in general to the West? He said it's not. There's some areas where maybe there's cooperation, but they're not friendly. And that's something to keep in mind potentially going into the future and drawing also lessons from the war in Ukraine.
Okay, Maria, thank you very much. Interesting to get Maria Tadeo and the highlights from that interview that she just had with the president-elect over there in Prague. Interesting to get that perspective from one Eastern European country at least. That is it for Early Edition. Surveillance is up ahead. They'll be hearing from Glenn Hubbard, Columbia University professor and former chairman of the Council of Economic Advisors. Great voice to have on the day you get the jobs report and in Fed Week. This is Bloomberg.
the standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
Markets should take notice. No one's pivoting anytime soon.
When you look at the market reaction today, I think what they're telling us is that string of hawkish central bank meetings is over.
It's not just about the Fed, it's also about what's going on in the rest of the world.
All central banks are going to be in a similar position. Key issue, of course, is the extent to which price pressures are coming off.
It's when the labour market breaks that we've really struggled.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Here are the year-to-date scores. The Nasdaq up 17% year-to-date. The S&P 500 up close to 9 full percentage points year-to-date. From New York City this morning, good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures, Tom, negative this morning by 0.8% off the back of tech earnings after the bounce yesterday. Going into payrolls a little bit later this morning.
Let's link tech earnings into the jobs report coming up as well. I mean, you're looking at layoffs and all that and right sizing and rationalization. The word I use is I thought it was clumsy, what we saw yesterday, and it was story to story. And the number one story I saw is, can Tim Cook go to Washington and solve everything? I mean, I don't know what else to say. Yeah, Apple's off today, but he isn't laying off anybody. He's sort of the anti-big tech right now, is how I'd put it.
I think you have to compare the moves this morning in the pre-market to the moves that are closed yesterday. And if you go through them piece by piece, Apple was up 3.7% yesterday. Meta was up 23%. Amazon was up 7%. Alphabet was also up 7% in yesterday's session. So when you look at the price action this morning, just compare it to what we did yesterday, and we're kind of like this, unchanged.
That's a really good point. Basically, we're retracing some of the optimism that we saw yesterday on the heels of Meta, that perhaps they're going to beat it out of the park. They're still up on the year. They're still doing really well. The key question here is this the beginning? And you talk about layoffs heading into the jobs report. Are the cutbacks that we're seeing enough to bring big tech in size with where the economy is right now? And who is to follow? And I think that really is one of the conclusions I drew from this.
Or the bipolarity here of 4 companies. We'll talk about this with Ron Temple in a moment. But this alternate universe of 4 or 5 companies, and everyone else, is, Lisa, with your earnings reports you've been doing, are absolutely brilliant, showing the rest of America.
Well, and I will say this, that if you look at the consolidation of profits, Apple consolidated 85% of smartphone profits last quarter. So when you talk about who's winning, this is the issue. Intel's losing, but you see Taiwan Semiconductor Manufacturing Company winning and Samsung winning. So this is winners and losers as well.
And on the unit sales, I don't have the Mark Gurman numbers in front of me, world class at Bloomberg, but John, basically iPhone, OMG, they're down X amount of percent, which was way less than the unit sales decline at Samsung.
That's the hardware unit. the iPhone unit at Apple. Let's talk about the cloud business. The years of acceleration are over.
Surprise, yeah.
The guide that we've had from Microsoft, we're looking at deceleration. The guide we're having from other companies now, Amazon, just to name one, it's the same story. We now need to think about deceleration, and that's a shift from the last 5 years.
And it's a shift with respect to hiring as well. When they start talking about how they're going to use artificial intelligence to boost things, they're not talking about the sort of seismic growth and expansion. They're talking about right-sizing the platform that they currently have.
But let's take this away. Let's ignore the earnings just for a moment. This is so painful for so many people. I think it's all well and good sitting here and saying, the weak data is going to come in a couple of quarters. I read that note from Mislav Matejka over at JP Morgan earlier this week, and this is not aimed at him, it's just aimed at the idea that you can be short this market in the face of a rally like this. It's so painful to do that. Tom, what we need to work out, is there a window of opportunity here? How big is that window? Is that window about to slam shut off the back of some really weak economic data or not?
I like what Olivier Blanchard says in his book, where he coins it the Biden stimulus, that last big pandemic oomph. We're getting over it, and it's affecting everyone. Take Amazon as a whole in spades, and the labor model is going to be the outcome for the American people. And, you know, you look at the jobs report we're going to see here at 8:30 in 2 hours or so, and, you know, I guess surveys under 200,000, that's beginning to show that labor range you're talking about.
189. Still pretty decent numbers.
Oh, I'm flabbergasted.
Down from 223.
Claims got buried yesterday. Was claims yesterday?
It was yesterday
Claims got buried yesterday. And look at the 4-week moving average of claims. It's a comedy.
Hey, phenomenal numbers. Futures right now down about 0.8%. Let's whip through the price action together. Equities today a little bit softer, but over the last week, the Nasdaq is on course for a 5th week of gains. Best week since November, up about 5% on the week already, and Tom up 17% year to date. That run is just phenomenal.
So for everybody, and thank you so much for staying with us on radio and TV over 3 exhausting days, really marathon days. How do you link this together, John? And I think the way you link it together is in today's jobs report, if you see some form of quiescent wage growth, that gives a further backstop to Chairman Powell to do what he shocked the world with in that press conference, and that extends out the duration play on tech and the NASDAQ 100 maybe, perhaps continues its lift.
The wages, Lisa, a big focus at about 8:30. I think he did all right.
I'm not awake, but fine. Tang Zero hasn't clicked in.
I will say, John, just picking up on what you're talking about, that's exactly what I'm looking for. You talked about the 189,000 number that a lot of people are talking about for the headline for the U.S. January non-farm payrolls report coming out at 8:30 a.m. I'm watching average hourly earnings. How much do they go down to 4.3% year over year versus 4.6%? Is that enough to give the Fed confidence to really downshift in tandem with what the market is currently expecting? 9:30 a.m. Joining you, John Farrow, Labor Secretary Marty Walsh, joining Bloomberg Television. I'm curious what he has to say about the push from labor. We see this even at Google, Alphabet, as people start to protest some of the layoffs and cutbacks. Does he support that, especially if that really pushes wages up further at a time when that could potentially create some problems for the Fed? 10 a.m. we get ISM Services index data. Do we get an actual reacceleration into positive territory, expansion territory? And John, we talked about what we saw in the manufacturing and the factory sector, very deep contraction that seems to be deepening. Perhaps not the same story over in services.
Bramo, thank you. Looking ahead to the data a little bit later, always fantastic. Just always
Did
up
we
against
get
on, wasn't it,
German
about
inflation?
That? No, not yet.
I looked this morning.
Next week. The Guard referenced that. Did you see the compare and contrast between the Guard and Powell? Were you surprised by it?
Well, she didn't wear the scarf for France. She wore the World Cup look the last
She
time
said
around.
the risks around inflation have become more balanced. This 24 hours after we heard from Chairman Powell saying the disinflationary process had started.
Yeah, my headline is I was significantly exhausted by 3 central bank meetings.
Once you've said that, when you follow it up with the same thing, which is we've got more work to do, no one's listening to that anymore. That's done. I want the new stuff. I'm focused on the new stuff. That's why for a lot of people in the market, Tom, they think these guys are done. One more and see you later. Finished.
Yes, there's no question the market is modeling. Are they modeling in at Hyman disinflation under 3%? Maybe not, but we're way beyond 7% angst.
Ron Temple joins us now, U.S. equity head and co-head of multi-asset at Lazard Asset Management. Ron, can we just start with this rally in tech? Not this morning, which is selling off, of course, but year to date. Ron, just phenomenal. Are you into that rally? Are you fading that rally? How are you even thinking about that rally?
Well, I think investors have gotten ahead of themselves in terms of basically extending that duration, as Tom just mentioned. I mean, this to me is largely about an interest rate call in the tech sector, where people are betting that interest rates are going to be down and stay down. And I think they're extrapolating far too aggressively in terms of that comment about the disinflationary stage having started. Yes, there are signs inflation is decelerating, but this inflation fight is not over yet. And I think investors are overestimating how quickly, or they're expecting the Fed to be cutting rates far too quickly and cutting them from levels that I think are too low. So I think this is a rally you do want to fade. Feels to me like people trying to basically make a play that we're going back to the good old days of zero interest rates in QE, and that is just not happening.
Ron, if it's a short cover in equities, and I would respectfully suggest in bonds as well, and if you got the gamma, the convexity, whatever Greek you want to use here, do you hedge the January lift?
Well, I mean, I guess I look at it, I think there are a range of factors going into it. Tom, I'm not sure I would call it short covering as much as, I guess you could call it short covering in some ways. I don't think it's a short covering rally as much as people were sitting on a lot of cash. If you look at the hedge fund market, basically a lot of the hedge funds were not highly levered coming into the year. And a lot of investors on the institutional side are really, it's a bit of a FOMO, a fear of missing out and a fear of being behind their benchmarks. And so they're feeling forced to get into the rally, feeling forced to extend duration. And so I think that's kind of, it's a pain trade right now. And that's where I think you would want to fade it in terms of trying to position. The hard part is, I don't think it's extended so far that it's an easy call to be saying, let's go short again on this market.
Ron, does the rally that we see now and the optimism around a soft landing ensure a deeper pain or a harder landing later?
Well, that's actually part of my concern is, I mean, if you look at the Bloomberg Financial Conditions Index, financial conditions are easier than they were a year ago. So you've had a Fed that's raised rates 450 basis points, and yet we have an equity market that's basically heading back higher. We've got credit spreads that are tightening, bond yields that are going down. This is effectively a market that, in my view, is almost fighting the Fed. Again, there's a little bit of selective perception here in terms of, you know, you hear Powell say disinflation has begun, but Powell's also telling you rates are going higher than the market's pricing and staying there longer. The market's ignoring the part of the message it doesn't like.
But Ron, aren't we just disagreeing on forecast? People are allowed to have a different forecast to the Fed, aren't they?
I actually do think in that regard, I mean, with all due respect, I think Powell does a fantastic job, but I think he kind of fumbled the messaging in the FOMC in the press conference by saying, okay, they just have different forecasts. That was pretty counterproductive to what the Fed's trying to accomplish, in my view.
Ron Temple of Lazard Asset Management, you weren't alone with that view. Let's be very clear about that. The penultimate question at that news conference has got so much attention. The comment on financial conditions, the comment on forecasts. Tom, I'm not here to change anybody's mind about their forecasts. I thought that's precisely what they have been doing for the last 9 months, which goes back to that quote. I think the perfect framing from Steve Englander yesterday, Tom. We've gone from conditional hawkishness, non-conditional hawkishness to conditional hawkishness. And that's a change.
Yeah, let's be clear. Dr. Englander is a Yale sophisticate. When you come out of Yale in the world of James Tobin and Robert Shiller and the rest, this idea of unconditional dynamics over to conditional dynamics, it's fraught with a lot of before the fact, after the fact dynamics. Guess what? I think Steve Englander would agree with us. They're still massively ex post, including what we're going to see at 8:30 this morning.
He speaks next week at the Economic Club of Washington.
Steve Englander?
Chairman Powell does. Are you expecting him to walk this back?
That's a really good question. I think he may send out surrogates to walk it back to maintain their ultimate fear, which is to lose credibility.
That's going to be how we kick off the week next week, isn't it? Is Chairman Powell walking this back, or is he repeating the message, which a lot of people received in the news conference this week?
If he walks it back, that's also perilous, to Tom's point, because there's a credibility issue. At the same time, it's clear, you talk about ex post facto, not necessarily. If they're saying that, you know what, we're worried about going too far, if the balance of risks have shifted, suddenly this is a very different Federal Reserve.
Equities down 0.9% on the S&P. Coming up in the next hour, Priya Misra of TD. Looking forward to that. TK, freezing cold in New York today.
Yeah, I'll give you that. Finally. It's like late March in Western New York.
Okay.
But, yeah.
What's the line in the sand for you? or the line in the ice, so to speak? What is it? What makes it cold for you?
Line in the sand right now is when you get 6 inches of snow and your dad says shovel the ice rink, and 2 days later you get another 6 inches, and you just don't.
Well, I don't think we're not getting snow, right?
No.
Just getting ice.
No, this is where I'm up towards the Arctic Circle.
We'll talk about the weather balloon next. Down in DC with Anne-Marie.
What's
Have you
the
seen that
temperature in
balloon?
Fargo?
Have you seen that balloon?
Yeah,
Isn't that a crazy
it's
story?
such a funny
Weather
story.
or China? China, obviously. That's next. This is Bloomberg.
And we're going to hit that story right now, Jonathan. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, the Pentagon is tracking a Chinese surveillance balloon that lingered at a high altitude over the western U.S. That balloon was spotted over Montana, home of the ballistic missile silo. Now, Pentagon advised against shooting it down because of the risk of falling debris. All this could complicate Secretary of State Anthony Blinken's visit to Beijing next week. The U.S. labor market probably continued to moderate at the start of the year. Still, wage growth, a historically low jobless rate, and high vacancies are expected to keep the Fed from lowering interest rates for some time. Today's jobs report is likely to show that payrolls rose by 189,000 in January. Shares of Apple are down after the company reported its worst holiday performance in 4 years. Supply chain issues and a softening economy hurt iPhone sales. Revenue fell 5.5% in the December quarter, Apple's biggest sales period of the year. Still, CEO Tim Cook sees signs of rebound in China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Will a slowing economy finally hit the U.S. job market?
The real test for the bear case seems to be jobless claims.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Have we returned to pre-pandemic labor force?
You could see jobs go down to, say, sub 100,000 in the next couple of months.
That'll get their attention on Wall Street.
The January Jobs Report, today on Bloomberg Television and Radio.
We believe the House cannot pass a debt ceiling bill the way they're talking about it. That if it is very minor cuts, the MAGA Republicans will rule it out. If it is major cuts, the more mainstream Republicans will go. That's why we're saying, show us your plan, because I don't think they can get one together.
Was Senate Majority Leader Chuck Schumer there? And Bramo looking for a sub 100K
That was
payrolls
not what I
report
was
a little bit
looking
later.
for.
Than
Are you serious? No, but, okay, hold on a second. No, I'm
was
not.
that a deep fake?
No, it wasn't a deep fake.
That
I was citing that some people were saying, including Morgan Stanley's Seth Carpenter, that in the next few months you could get sub 100,000 possibly,
Maybe.
and that would get a bit of it. I'm not saying that, just to be very clear.
Unless it is sub 100K, in which case, great call, right? That's how these things work.
It was ChatGPT.
Yeah, right. Equity futures right now down 0.9% on the S&P. Earnings not tremendous from some of the big tech players after the close yesterday, but the rally we've seen so far year to date really is the headline. On the Nasdaq, up by 17% year to date on the Nasdaq 100, on the S&P up close to 9%. Futures lower, yields unchanged, 338.85, and Tom, euro dollar 109.28 on euro dollar.
After the marathon 3 days we've had, can we institute surveillance GPT? I mean, it would be...
You want to do AI for surveillance?
Yeah, well, we do it every day anyways. We might as well just codify
deep
it.
fake the anchors.
Right.
Michael Harney of Bank of America this morning told me, said this: most painful trade is always the apocalypse is postponed. He says we say fade the S&P 500 above 4.2K on peak Goldilocks this month.
With immense respect, the writing this weekend is going to be superb. And we got to get to Anne Marie here in my childhood. But, John, the bottom line is you got Dan Ives at 9:30 this morning.
Looking forward to that. AMH is too, to talk about your childhood.
He's got some ups.
She can't wait if she's still there.
I'm not going to go into the details because we don't have time. But long ago, when I was 7 years old, I stood in the grass with a bunch of fancy guys with spy cameras, and they looked up at the sky, not at Sputnik, but a thing called Echo. Echo was a big white balloon, it felt like, going through the sky that revolutionized how we communicate. It was trying to bounce radio waves, information from the ground at Vandenberg and other places, up to Echo and down again. Anne-Marie Orden here, our Bloomberg Washington space correspondent on the modern Echo, which is a Chinese over. What are they over? What are they taking shots of, Anne-Marie?
Well, at this precise moment, we don't exactly know, and the administration's not telling us the location of the surveillance balloon, but this surveillance balloon was spotted over Montana, and the concern is, of course, that's where we have intercontinental ballistic missile silos. So this is a concern for the administration, given the fact that why are, the big question, the Chinese sending this surveillance balloon over the United States? Particularly the timing of this is questionable, given the fact that Secretary Blinken is headed to China next week. But also, China already has low-level satellites that can also have the capability of doing the same exact thing as this surveillance balloon. So why did they send this surveillance balloon? Because obviously this is getting a lot more attention.
I know your phone is rung off the hook on this, and there's all, I mean, this, folks, really truly goes back to Sputnik in 1957. A question from 1957, can we shoot it down?
Well, at the moment, what the U.S. has said and what Secretary of Defense Lloyd Austin, what he'd said to the president was we should not be shooting it down because potentially there'd be a lot of damage from the debris that would come down from it. And they don't think that the capability of this surveillance balloon is such that it's worthy to have that potential debris. So they probably have the capability to shoot it down, but they have decided not to.
I think the key part of this story, Tom, is it's not the first time they've spotted this. They're well aware. They're well aware that this has been going on. And with that in mind, Anne-Marie, the talks will continue because the talks never really stopped between the two sides, even when they knew this was going on.
Right, and also, obviously, for decades, the Chinese have also been talking about the fact that the U.S. has sent spy planes and ships as well spying on them. So this has been a fraught issue, a moment of tension between these two sides, as you say, Jonathan. But I think a big question this morning is people are actually asking, will Secretary Blinken go on this trip next week to China, given the fact that this administration is getting a ton of pushback from the Republican Party and using this instance with the surveillance balloon as a reason to potentially maybe Secretary Blinken needs to rethink. But this trip was supposed to be important. This was, the next stage of setting that floor under the relationship of the world's two biggest economies.
Well, tell me about the latest reporting. Where are we with that meeting? Is it still going ahead? Have they responded to questions about that in the last 24 hours?
Yeah, at the moment, nothing has changed publicly, but these are conversations that I imagine are happening behind closed doors. The Wall Street Journal is reporting that the State Department called in the representative from the Chinese embassy, because there's no new Chinese ambassador, but Charge d'Affaires was called in. So this is going to be top of mind for everyone in Washington, D.C. today, especially when you have the likes of Rep. Gallagher, who is responsible for this new China committee that is looking at the threats from China, saying that nothing has changed with the Chinese Communist Party, even though there are potentially these warmer talks.
It's ironic that even as earnings come out for some of the U.S. companies that are the largest and most profitable, I'm thinking of Apple, and they point to China and the recovery there as a point of optimism in their earnings, that the U.S. sees tensions increasing with China. How is Washington reflecting this growing divide between what we're seeing in D.C., the Beltway, and Wall Street?
It's really difficult, Lisa, right? Because the business community is entrenched in doing business in China and making sure that they're part of China's reopening, the growth story in China. But at the same time, the administration is trying to put guardrails on all parts and all avenues of this relationship between the United States and China, whether or not it's business, whether or not it's national security. I mean, at the same time, you're talking about Apple, looking at what's going on in China. You have this morning news out that the Philippines and the U.S. also are going to start once again joint drills on the South China Sea. So it's a difficult moment to balance.
Emery, help me
Tom
here.
doesn't agree.
It's a no, it's not that I disagree. I mean, this is a serious matter. I get that. I mean, to be blunt, I grew up with it. Emery, to be as direct as I can, it's a balloon. It's not going to turn right over Montana and spy on the Eagles training camp for the Super Bowl for the Kansas City Chiefs. It's a balloon. So it floats over Pharaoh's apartment in New York in a couple days. It goes over the Atlantic Ocean. Where's it end up? Portugal?
I don't know. I'm not a surveillance balloon expert, and quite frankly, I didn't grow up with them the same way you might have grown up with them. I mean, they are still used for the most part. A lot of countries, when they want to conduct surveillance over other countries, they use drones or they use low-level satellites.
Is that why Arsenal beats the tots all the time?
With drones.
With drones?
They use drones for training now. Do you know that?
I did not know that.
They do.
I saw it on Ted Lasso.
Just to look at the pitch movement and make sure people are in the right places. Arteta's doing that at Arsenal. AMH, thank you.
AMH killed it.
Just fantastic. Anne-Marie, thank you very much. Look, this is a tough situation.
It's serious.
AMH has touched on it, and we talked about it yesterday. Tim Cook is fantastic at navigating both sides of this, the China side and the US side, and seemingly doesn't ever seem to get caught in between. I find that remarkable, Tom, how he's pulled that off.
Ask Dan Ives about this, and my answer to the iPhone supply constraints and the fancy phone is doing it well is both American citizens and Chinese citizens want the product. That's the common feature.
So I've done some research, and The Guardian has an explanation about why balloons can sometimes be used. Be used instead of satellites, and they're much cheaper to launch, and they can target from a much more comprehensive amount of land with a longer duration from closer down. So that's the reason why people are actually returning to the old once again.
Thanks for that. Thank you. You seemed eager to fit that in. We appreciate it.
I actually think that's interesting, because why would you go to a balloon if you have satellites, right? Like, it's so low tech that people are laughing.
You ready?
I mean, it's like sticking a little helium.
We had a mock-up of Echo 1 in the basement. We had a mock-up, a small white thing.
In the basement?
That he used for telemetry, yes.
Did you, like, ride it around the basement?
No. But we had a mock-up of Echo 1 in the basement.
That's serious stuff.
We had a V1 rocket engine, too.
Very cool.
life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
Equity futures right now, negative 0.8% on the S&P 500. Good morning to you. On the NASDAQ on this payrolls Friday, we're lower by 1.4%. Lisa will run you through the tech earnings a little bit later, but not what maybe some of you expected on the bullish side. But wow, have you had a rally already this year, Tom? Just a move of 17% on the NASDAQ, just a casual move higher of, what, 8-9% on the S&P 500 year to date.
It continues. In the sell side, Jim Suva over at Citigroup, you're going to have Dan Ives on later. The sell side is massaging the duration of this carnage. And you mentioned this earlier. All of a sudden, there is a cloud mystery. You know, Anurag Rana's territory. There's this new mystery about the cloud. But other than that, it's sort of pandemic-y, COVID-y. Is, you know, when they get out of that, then what?
There was a massive expansion in the pandemic, as you know. Apple hasn't had the cuts because Apple didn't have the massive expansion. The cuts have been elsewhere. We've seen it with Meta, and that's why we're seeing a turnaround now. The year of efficiency from Facebook. I want to touch on the bond market briefly. 2s, 10s, and 30s look like this on a 2-year right now. Yields lower by a basis point, 4.0894% on a 10-year, unchanged, 338.85 on a 10-year. And finish on foreign exchange, euro dollar. Chairman Powell sounding a whole lot like President Lagarde. We've got more work to do. It's premature to stop. We know it's not over. What did Governor Bailey say yesterday? Too early to declare victory.
It's very Churchillian.
And then at the same time, when you say things like the disinflationary process has started, okay, that's new. I'm listening. Tell me more. And then President Lagarde says the balance of risks around inflation have become more
I'm going to
balanced.
cut him some major slack.
Tell me more.
I'm going to cut him.
You always do.
These guys are institutions. Their number one thing is, as Lisa mentioned earlier, is credibility, and I'm going to cut him some major slack. They're in tough positions given the deck of cards. Bramowitz has got the Bramocam. Fire up the Bramocam.
Look, we all knew this was going to happen. We'd get to peak inflation and perhaps past that, and that seems to be certainly the case, or it appears to be the case, I should say, in the United States. Now the question is the market ahead of the Fed? Is the market perhaps racing to the horsing, what's the expression?
Oh, no, please, carry on.
Please help me. No, but in seriousness, like whether they're getting ahead of themselves in terms of how far inflation will go down. Will this market get a reality shock if inflation doesn't go down from 3% to anything lower?
Look, from my perspective, it's not about cutting them some slack or having a go at them. I'm just focused on the new information. I don't care about the old stuff on repeat. I care about the new stuff, and we got some new stuff from them in the last couple of days. They've clearly shifted a little bit. Now it's over to your own personal forecast. Where do you see the data going? That's up to you. And Chairman Powell, I think, finally just saying, you know what? I don't care about your forecast. Have your own forecast. You can have a disagreement with the Fed. What's wrong with that? You can have a disagreement with the Fed on their forecast. You can have your own. We'll find out. What's interesting for me right now is that you can believe in the soft landing story, buy equities, buy risk, all of that good stuff, great. You can believe in the hard landing story, but also be thinking about doing the same thing. Because you've got to work out, if you believe in the hard landing story, when does the bad data really start to hit? And if you're pushing that out, is there a window to keep buying risk? And that is ultimately Binky Charter's point over at Deutsche Bank. We're pushing the recession call out, for him at least, not my view. And if he thinks you're going to push it out, he thinks this rally can continue.
Interestingly, Michael Hartnett, who also came out with apocalyptic discussions about pushing it out in the pain trade, also sees